What is up, beautiful people? Welcome to How to Trade, Learn How to Trade, formerly known as Midday Show. That is your girl, Adara. I am Sharif, and we're going to wait till the chat populates as everybody moves over from the other stream. We got our own stream now, Adara, so I guess we should be kind of happy about that. The only thing is, it takes a little bit of time for people to... There is Pitchbull, Bob Dub, the Crazy Stitch Lady, Roger, Aft, D-Loaf, Renata, Mathis. What's up, man? We got Raphael, we got Paulie, we got Cam, we got Monty G. That's a hell of a name there, Monty G. Dad Trader loves the futures. I know that about Dad Trader. JB, Alex, Adam DeLuce. Woo. My man, 2-1 against Wolverhampton. That's all I got to say to you, Adam. And we are top of the league. We are top of the league. What's that? What's that chant that Arsenal sings that when we're top of the league? Best one. Sailor Moon. She is the one named Sailor Moon. Katina Man doesn't like that. Nick Dub, Alex Davis, that guy, Miss Gill, everybody in the chat. Welcome, guys. Welcome, guys. We have one topic to talk about today. One. It's not really a topic, it's an entire theory, hence why we can only include one of these. And it is called prospect theory, otherwise known as loss aversion theory. We're going to talk essentially about it, but it's basically human compulsion to want to take what they perceive as to be the winning, the gain trade, rather than, actually looking at the stats and the data. And, even though there may be loss, prospects in one, they choose to take one over the other. We're going to talk a lot about that and how that plays in to human psychology. We are talking about prospect theory, guys. Again, a pseudonym for it is loss aversion theory. Very important. We'll be talking this entire week about trading psychology with a different topic every day, hopefully to shed some light on why we do some of the things we do, Adara. But before we continue, how was your weekend? My weekend was good. I went to like a holiday party with like family, like extended family over the weekend, so that was really nice. Mostly like slept yesterday. Okay. But yeah, no, it's been like a solid weekend. Very happy to be back though. I'm super excited about Psychology Week, as I was kind of talking about yesterday. Took a lot of interesting notes and stuff today. Very excited. How was your weekend? It was really good. Awesome. I actually set a record for my strength training personal best. I burned 1,557 calories during one strength training workout. That is my personal best. What kind of stuff were you doing? Legs. Like, legs. Yeah, it can only be legs. That I was going to say, I don't know how you that's a lot of calorie burning for arms. A lot. That would be very impressive. Yeah, can you imagine for arms? Oh my God. That's still crazy though. Yeah, congrats. 2 hours and 40 minutes it took me, Adara. I burned active calories, 1,231, total calories, 1,557. I am awfully proud of myself, but that's neither here nor there. We are going to talk a lot about now prospect theory, so let's just get right into it because there's plenty to talk about right now. What the dang is prospect theory? Prospect theory assumes that losses and gains are valued differently, and thus individuals make decisions based on perceived gains instead of perceived losses. I know it sounds vague, but as we go on, it's going to get more clear, guys, so just be patient, okay? Also known as loss aversion theory, the general concept is that if two choices are put before an individual, both equal, both choices being equal, with one presented in terms of potential gains and the other one presented in terms of potential losses, the one with potential gains will be chosen by the individual. And, it sounds like, well, that's obvious. They're going to choose gains over losses. No, but they are both equal. And you're going to see an example in a second. Just be patient. How does it work? How does prospect theory work? Prospect theory belongs to a larger group of trading psychology called behavioral economic subgroup, describing essentially how individuals make choices between probabilistic alternatives where risk involved and the probability of different outcomes is unknown. Okay, the theory was originally formulated by this two dudes named Amos Tversky and Daniel Kahneman. I hope I didn't butcher that last dude's name, but it's a bit of a mouthful there. The underlying explanation for an individual's behavior under the prospect theory is that because the choices are independent and singular, you have to make one choice as opposed to the other, the probability of a gain or loss is reasonably assumed to be 50-50 when it's actually not, instead of the probability that's actually presented. Essentially, the probability of a gain is generally perceived as greater. Again, I know it sounds very vague, but example coming shortly. Tversky and Kahneman propose that losses cause, this is absolutely accurate, listen to this. Tversky and Kahneman propose that losses cause a greater emotional impact on an individual than does the equivalent amount of gain. Adira and I and Obi and I have talked about this very thing right here, where it was an anecdotal conversation I told you I was having with my dad. I'm like, Dad, you know, when I take an L, the losses fester far longer than, you know, the exuberance and the euphoria after a dub. Yeah, actually, it's like very accurate. It is. It is. I've personally experienced it, and obviously there is some scientific information here to back it up. Okay, so Tversky and Kahneman propose that losses cause a greater emotional impact on an individual than does an equivalent amount of gain. So given choices presented in two ways, with both offering the same result, an individual will pick the option offering a perceived gain. Here's an example. For example, assume that the end result of receiving $25, okay, one option being you're given $25 outright, the other option, you're being given $50, and then you actually have to give $25 back, right? So absolutely, they are one and the same. You're going to end up with $25. Just one, you get it outright. One, you have to suffer an L, okay? The utility of the $25, we know, is exactly the same in both options. However, individuals are more likely to choose to receive the straight cash because a single gain is generally observed as more favorable than initially having more cash and suffering a loss. That's really interesting, and I didn't know that, but it makes sense because it's like it's all like how we perceive things, right? So if we perceive we're giving up half the money, then we're like, oh, we're losing, even though literally you're getting exactly the same amount. You're not. All right, and some people are making comments in the chat about taxes and stuff like that. All things being equal, guys, forget about the taxes. Hypotheticals. Don't take it too, don't try to do a practical application of these examples. Try to absorb them for the message that they're trying to send you. That's what I would say to that. Continuing on. There are different phases of prospect theory, essentially two. There's an editing phase and an evaluation phase. Sounds fancy, but there's really nothing fancy about them. We just got to get through them in order to get to the crux of the theory itself. Prospect theory asserts that decisions are made through a two-stage process, okay? Two-stage process. Instead of considering all available information and possible options, which would be literally impossible because we don't know all the different variables, humans use a two-step process to narrow down the most important information. These steps are described as the editing phase and the evaluation phase. Starting first with the editing phase, Adira. The editing phase is where people decide which information will be used in the evaluation stage. So you're going to narrow down the factors and variables that you are going to assess when you are in the evaluating process, which is step two. Decision makers will use mental shortcuts to assess which information is important and what options are available. They also decide which outcomes are more desirable even rank their priorities. And we're going to talk about this because this comes into play later on when we talk about biases. The editing phase is important because it can introduce biases that emerge later on in the decision process. If an individual does not consider certain unlikely outcomes or make an incorrect assessment of that outcome's probability, they may end up making what they call suboptimal decisions. Okay. So that is the editing phase. The evaluation phase sounds exactly what the name describes. This is the stage where people make their final decisions. Surprise, surprise. Based on the assessments made in the editing phase. People weigh the probability of each outcome and take actions based on the perceived likelihood and the desirability of each outcome. It's important to note, though, here that these decisions are not necessarily based on rational calculations. Biases sometimes are not based in logic or don't actually have a rational basis. And I believe that wholeheartedly, just given my own experience. Prospect theory posits, see, Sean, I'm not the only one that says posits around here. The document says posits as well. Prospect theory posits, because you always get excited when I say submits or posits and stuff like that. There you go, Katina, man. He's too busy printing over there to notice my joke. Prospect theory posits that people tend to be risk averse when the stakes are high and risk accepting when the risks are low. In other words, they tend to make choices that minimize their losses rather than maximizing their potential. That is an issue right there. Listen to that again. They tend to make choices that minimize their losses rather than maximizing their expected gains or their potential.
Huh. That's really sad. Yeah, it's the idea. Yeah, and I think too, part of it comes from, like, I think we were having this conversation, I think too, with the chat a little bit back in Risk Management Week. But yeah, I think there's this thing where we're inherently kind of harder on ourselves. And so it's easier to berate ourselves when we do badly than celebrate ourselves when we do well. And I think that goes like part and parcel. It's part and parcel with what we're talking about here, which is this idea that we're more focused on potential losses than potential wins, like even if you have solid setups. And maybe that's why we leave good trades early sometimes. Like I think it all kind of comes back to the same concept.
Isn't that the truth? All right, some characteristics. We're getting to the punchline here, guys, I promise you. Characteristics of prospect theory. Prospect theory suggests that humans tend to prefer certainties over probabilities, even if the probabilities present a higher potential yield than the certainty. Okay, humans prefer certainty over probabilities, even if the probabilities themselves present a better upside than the certain outcome. Okay, think about that. For example, suppose that you have a choice between being given $50 and a 50% chance of winning $100. Again.
So then wouldn't it make more sense to get the $50?
Well, you're going with the whole thing here, Dara. Okay, so look, I'm not pointing fingers. No, obviously, I probably would have said the same thing.
Yeah,
fair. Yeah. Okay, but according to the science, it's not the right decision.
Really?
No.
Okay.
For example, suppose that you have been given a choice between given 50 and a 50% chance of winning 100. Most people will take the 50. Okay? Even though the expected value of the two options is the same when you look at it from a statistical perspective.
Ah, okay.
Okay, you see what I'm saying?
Yeah.
Prospect theory also asserts that people underestimate or even ignore outcomes with a low probability. So they tend to look more at the higher probability, more certain items rather than actually discounting the lower probability items. Consequently, they also tend to overestimate the probability of likely events. So not only do they discount or less heavily weigh lower probability outcomes, but they tend to overweigh likely probability.
Oh, okay.
You see what I'm saying?
So basically, if something is less, or you think something's less likely to happen, you're basically discounting it entirely, where if something is more likely to happen, you're putting way too much stock into it.
Get the bang for that.
That's crazy.
Okay? Resulting in a bias that neglects the improbable outcomes. This is particularly relevant to investors who must consider the possibility of unforeseen events, and we call that black swan events. And there's actually ETFs, entire funds, hedge funds that are black swan hedge funds. Yeah, Google them. It's like they bleed for years, and then COVID hits. And they go like 10,000% up.
That's crazy.
Bleed. The great financial recession, or whatever they're calling it now. It hits, and then they make a killing. Or the .com bubble comes, and they make a killing. There's an entire black swan hedge funds, but that's neither here nor there. How to overcome biases. Very important. Understanding prospect theory can help individuals overcome their biases and make more rational choices. For example, an investor who is aware of their bias towards high probability events can compensate by giving extra consideration to low probability ones. So that's an easy fix. It also helps to reframe the possible outcomes in a way that reduces the impact of your cognitive bias. Instead of thinking in terms of gain or loss, which is what we're all really programmed to do, myself included, you can instead think in terms of value expected outcomes without using the present as a reference point. This can reduce one's overall aversion bias. So look at the possible the actual quantitative return rather than the probabilistic return. Okay, the outcomes.
Okay.
Before I continue, any questions? Because like we really haven't, you gotta get the full picture in order to
ask
questions.
No, I think I'm just kind of taking it all in right now.
Yeah,
I think it actually, as much as it is deep, I actually think it's kind of straightforward. Hopefully, like I think it's a little bit more straightforward than I think I was expecting, because a lot of it's just kind of like making our minds, I guess, better.
Literally what it is.
Yeah, it's just like mind.
It took me a few times too. I read this like 3 or 4 times before it really sunk in.
Yeah, well, that was the same with like the reading I was doing this morning.
Which is fine because we're going to go over it umpteen times.
And then you learn more.
According to Tversky and Kahneman, the certainty effect is exhibited when people prefer certain outcomes and are underweight outcomes that are only probable. Okay? The certainty effect leads to individuals avoiding risk when there is a prospect of a sure gain. That's a problem. It also contributes to individuals seeking risk when one of their options is a sure loss.
That's crazy.
All right, the isolation effect, which is also part of the outcomes, occurs when people they were presented with 2 options with the same outcome, but different routes to the outcome. So, presented with 2 options with the same outcome, but different routes to that outcome. In this case, people are likely to cancel out similar information to lighten the cognitive load, and their conclusions will vary depending on how the options are framed, and we're going to get to an example of that. Consider an investor who's given 2 pitches, and I have to use your name in here, I'm sorry, I don't actually mean anything bad about you, but I wanted people to actually have a real-life example rather than saying the person.
Yeah, that's fair.
Consider an investor who's given 2 pitches for the same mutual fund, okay? I'm going to pitch you, and Sean's going to pitch you a mutual fund. The first advisor presents the fund to Adara, highlighting that it has an average return of 10% for the last 3 years.
Okay.
So I pitch you that it has a 10% return for the last 3 years. And then Sean comes along, right? A glass half empty type of guy. He's not actually, but I'm just, in this case, he's gonna be. Meanwhile, a second advisor tells Adara that the fund has above average returns over the last decade, but has been in decline for the last 3 years. They have the same return. Okay. But I pitched it to you that in the last 3 years, it's up 10%. And then Sean gives you a wider picture of 10% and says it's been on the decline the last 3 years. Same thing. The person, Adara, according to the science, is more likely to choose the former rather than the latter.
Yeah, because it's recency bias too, right? Like I'm looking at what's most recently happened.
Very good point.
The Sean example, or like Sean's fictional mutual fund has been more on the decline, even though it still does have stronger returns over the past 10 years.
BT 2020 says Canadians don't play baseball. How can they pitch it? Have you heard of the Toronto Blue Jays?
I was gonna say, I think Canadians do play baseball.
Come on, bro.
Yeah.
Come on, bro. Prospect theory says that although Adara has been pitched the exact same mutual fund, she is likely to buy from the first advisor. Moi. That is, Adara is more likely to buy the fund from the advisor that expresses the fund's rate of return in terms of only gains, while the second advisor presented the fund as having high returns, but surprise, surprise, they also have losses. That's reality. What does prospect theory mean? What is it trying to get at? Prospect theory says that investors value gains differently than losses, okay? That is, if an investor is presented an investment option based on potential gains and another is based on potential losses, the investor will choose an investment where potential gains are presented. Different way to view that. Why is it important? It's useful for investors to understand their biases. You have to be cognizant of them. Where losses tend to cause greater emotional impact than the equivalent gain. And that I could not be more in agreement with. Where losses tend to cause greater emotional impact than their equivalent gain. The prospect theory helps describe how decisions are made by investors.
Yeah, no, I think that's really interesting. And I think also too, like, it's interesting to kind of think like, how do we overcome stuff like this, right? Because we all kind of deal with it as traders. And I think being cognizant of it and recognizing that we do have these biases, I think can maybe help work towards fixing them. And I was reading this morning too in my notes about this psychologist named, I think it was Wells. I'm gonna get his exact name here. I do have my notes out here. But so he, I guess, had worked with a whole bunch of athletes. Norman Wells, who is a German psychologist, he worked with a lot of athletes initially, basically to help kind of improve their performances.
Okay.
And so then he started working with traders because he became really interested in the market. And his whole thing was, if you're not willing to adapt your personality, then you're not going to be a successful trader. Which is, I don't know, like I think that's pretty extreme, but basically like there are results with that. And I think it comes back to what we were saying too, right? Where whatever your natural personality is, it will play a role in your trading. So yeah, he said basically you have to kind of develop trading brain, which is where you're more cognizant of the role that the mental elements or your own psychology will play in your interactions with the market, which I think was pretty interesting.
I gotta agree with that.
Thought there.
All right, let's go to the chat here because we got some very good commentary coming in. King of Chaos, love the name, by the way. Fantastic handle there. Hey, Sharif and Adara, please, for once, check the chart of Nifty. I have invested in it by ETF, and I want your view on the chart. Thanks in advance. Love from LA. All right, because you asked nicely, even though it's not on topic, I'm going to do it for you. And you have a cool screen name, too, so how can I?
I love it.
Chart, Ram. Is it Ram? No, it's still the Chilean nightmare, so I can't say that yet. All right, NIFTY. Here we go. Let's have a look at Nifty. Taking a little bit of time to load up here. Pardon me. I'm not sure why it's taking so long. What the hell is this? This is not Nifty. NIFTY. Nifty Index. MCNA. Okay, hold on. What the hell? What's the ticker for that? Is it NIFTY, King of Chaos? Tag me again. Kling Daddy, Sharif. What if Kramer proposes the same fund?
There's so much. Funny. People are so hard on that man.
Yeah, well, he brings it on himself.
That is true. He's very confident always, too.
And like he always like receives CEOs of companies that are reporting, and he doesn't grill them. He really gives them an easy.
Okay,
and that's
so that
the
makes
truth.
Sense.
INDY. Is that similar to Nifty, Katina Man? Okay. Look, without even looking at it, I'm not long in my personal account in India, but I'm very bullish India. Okay, whether it's because of friendshoring or because they have a booming population, what's it called? The decoupling from China. I'm very bullish India. Brendo and I have talked a lot about it on the big desk. I don't know whether I would pursue it from an ETF perspective, like the way you're doing it, or I take it more from a stock picker's perspective. I'm bullish India. India is up and coming. There's just no doubt about that. INDY. The Katina Man says INDY is the India 50 ETF, and he's bang on. Let's have a look at the daily. I don't know what the year-to-date action is on this bad boy, but having a look over here, where does the year start? Adara starts over here. We're up a little bit. Looks like we started out the year in Jan at that, let's say, $42 area. Now we're knocking on the door of 47. We are definitely in a consolidative area here, despite the fact that we've been making nicer, higher lows since March onward. We have had trouble breaking through that 48 area, 49 area. That takes us all the way back into March of last year, into March 2022. So we definitely have a bit of a consolidative top here that needs to be taken out. I'd say a 50 break here gets me really excited. You know, that probably puts us at near all-time highs when we get to that 54 top that we made in November of 2021. No shock that it was made around that time. That's when the market peaked, and that's when Jerome Powell used the word, the phrase, not transitory, and the market sunk after that. You know the rest of the history. So I do like India, just as a little statement. John Del Segno. Sharif, this theory is all very derivative to a famous philosophy study, the Monty Hall problem. Good, thank you for letting me know that, John. I'll wet my beak onto that, and I'll find out a little bit about the Monty Hall problem. I haven't heard it. I haven't heard that name before. Maybe I've heard derivatives of it. All right, let's just see what else people are saying here. Paulie D, Sharif, that's why avoiding large losses references the basic concepts of day trading and getting out of a bad trade quickly. Couldn't agree more, my friend. We're going to be talking a lot about that in the coming days. We just figured we'd start off the discussion with the more theoretical component and then get into the more practical side of things. Harry Lou, what's up, Harry? Adara, Sharif, is there a schedule of topics you'll be covering for the week or coming weeks online? We don't have one online. That's a great suggestion, Harry. Yeah, it is. Maybe we should start putting these week by week, but we will be covering from now until Friday, trading psychology, the different lessons you'll find out day to day. I'm going to run it by Brendo, see if we'll have something for you, or for everybody, in fact, on a weekly basis. Thank you for that suggestion, Harry. All right, Adara, anything to talk about here quickly as we, or anything to ask here about prospect theory?
Nothing here. I think right now, I think like it pretty much makes sense. I'll probably have more questions too, kind of as we go, as I usually do. Yeah. But also shout out to Tushar in the chat. It's so good to see Trader TV giving a platform to new traders like you to learn over the stream from the professor. Lots of respect to Trader TV. Thank you so much for your lovely comment. And yeah, I feel very grateful to be here chatting with Sharif here, learning about stocks. But yeah, so I mean, also I can just kind of provide an update. I am in the GM trade because GM got lots of upgrades today, including Citigroup raising its price target to 95, which was staggering to me personally. Very much of note. Yeah, so I'm in this one right now. I don't like, we were having higher lows and then we didn't, so I'm trying to get it out of this around where that EMA is, 33.15, because getting a little bit nervous. But yeah, I mean, as long as we don't break a lower low, not a bad time. But yeah, no, I think it'll be interesting too to kind of see how, because I mean, especially like with myself too, I think my goal here too is to kind of try to apply the lessons we're learning to the trades I'm making. So I'm really excited to hopefully make some smarter trades and smarter entry and exit decisions through what we're learning about this week.
Absolutely. All right, I wanted to mention quickly here the NQ. The ES. Now, typically that I'm always looking at the NQ, but I was interested here on a level on the ES. Why? Because we knocked on the door of that 45.50. And like I've been saying, literally every morning at the big desk there, I am very enthralled with this 45.50 base. Look how long it takes us back, guys. We have been doing this 45.50 dip and hold, essentially, Adara, so November 21st. So we had a big boy down day today, and I'm looking for a 45.50 hold. We're at 45.60 at the moment. We'll see what we get. Obviously, it's a counter trend trade. We are down 0.88 or 0.89% on the ES. I am looking, though, for that 45.50 hold. You may have to give it a couple of points south in case it does break. We're going to watch and see how it trades around there. But it's an interesting look on the ES, 45.50 hold. Right now, though, what I see is a downward channel that hasn't changed. We still have lower highs and lower lows, and we are sub VWAP. To really change this trend, we're going to have to break above that 45 3/4 and close above there. Otherwise, the downtrend is still intact since essentially the bell, right? So I just want to point that out to you guys. I'm interested here in a 45.50 hold on the ES today, just because of the historical significance of the trade, and going back to the beginning of the third week of November.
Yeah. That looks like that's solid. You're right. Like if that hold breaks either direction, that could be very interesting.
Well, we shall see. A couple of points that I wanted to make in addition to what I've already said about prospect theory. There is a couple of things. There is another aspect to this called diminishing sensitivity, and essentially what that theory is suggesting is that you are likely to be more exuberant about a $10 gain if the profit was from $10 to $20, but less exuberant when the profit is from $110 to $120. Essentially, what the theory proposes, and the theory proposes that individuals exhibit diminishing sensitivity to changes in wealth or well-being. In other words, the perceived impact of a change diminishes as the magnitude of the change increases. So, sure, you're going to say to me, well, Sharif, a doubling of 10 from 20, that's a 50% gain, right? That's big. Sorry, that's a 100% gain. That's big. Whereas the increase from 110 to 120 is a fraction of that. Well, you're absolutely right. but it's still the same notional value that's changed, right? Percentage is different, notional is the same, but the whole point is when it gets bigger, the notional change makes you less sensitive to that. So that's one. And then loss aversion, which is the one that I really want to harp on the most here. The value function is often depicted people tend to be more sensitive to losses than gains of equal magnitude. Loss aversion implies that the pain of losing is psychologically more intense than the pleasure of gaining. And I hate that.
That's painful.
But it's absolutely accurate, and I've experienced it myself. The asymmetry in the evaluation of gains and losses can influence decision making, and that becomes a problem when it actually factors in, like the anticipated feeling of the L or the dub actually has an effect on the decision-making process. It should be entirely devoid of that, but it's not.
So basically, we're stopping ourselves from winning then, or from taking potential wins.
You may be.
We're so worried about the potential loss. That's fascinating.
Yeah.
Yeah, like
you absolutely may be.
I think too, like I hope, like as we kind of learn about it too this week as well, like, you know, for myself and for everybody here watching too, hopefully we're kind of able to take more of a look and a step back at trading kind of as we're in the trades too, right? Because I mean, like you're right, like we could be stopping ourselves from entering trades.
Exactly.
But also I think it's good to kind of keep yourself in check while you're in the trades, which is something I've been trying to work on because I, you know, have a tendency sometimes to leave the party a little too early. But yeah, no, I think sometimes like the issue is not even getting in the party in the first place. So hopefully we can kind of work on that.
Bang. Interesting comments coming in here. Duke 684 says, Sharif just picked up Trading in the Zone. Good read so far. Trust me, my man, you will like it. But if I could make one suggestion, it's going to be one of those ones where you need to read it multiple times in order to really internalize it. There's a lot of, well, unless, you know, you're one of those ones that absorbs it first time, in which case I envy you. But there's a lot of, like, you know, nuanced ideas that he introduces into the book. Some of them seem a little abstract when you read them the first time, and then, you know, you read it the second time, it seems a little bit less abstract. Third time, all of a sudden you're able to make those connections to your actual trading, and so they seem a lot more you know, real and more nuanced. But that would be my suggestion to you a few times. You don't have to read it back to back. You know, you read it the first time, you do a little bit of trading, you apply some of the principles, you come back to it after a few months, you read it again. It really helps internalize it. That was my experience. Yours might be different. Pepper Potts has a question for you.
Oh, yeah. Okay. Sorry if I missed this, but can you guys provide more detail on Sharif's sources or resources for further reading? So, yeah, I use like a lot of Investopedia myself.
Likewise.
I find that really helpful. Yeah, I know you do as well. I think also too sometimes, like even just kind of, especially with stuff like trading psychology, I think you can kind of get insights from talking to other people too.
Yep.
As you know, cliched or trite as that might sound, I do think that's very helpful. Also, I think too, like, you know, like reading books like the John J. Murray, I believe is his name.
John J. Murphy, yeah.
John J. Murphy, sorry.
Yep.
That, his book as well, Technical Analysis of the Financial Markets,
yep,
which Sharif recommended to me that I'm perusing through right now, working through. That one's really solid
as well. How's that going, by the way?
It's going well, yeah.
You like the way he writes?
I mean, it's very intense, but I think he like organizes stuff really well,
yeah,
which I find helpful. Yeah, I mean, I think also not everyone is going to learn from the same kind of resources.
No.
Like, I think you need to find what works for you. I find for myself as well, as someone who's like very new to the markets at large, podcasts too have been really helpful.
Absolutely.
So listening to like the Compound, they put out like a couple podcasts a week, and even just like they have a really good habit of usually explaining things too if they're mentioning something not everyone might understand. So yeah, I think there's a lot of different types of resources. You need to find what works for you.
Speaking of podcasts, Adara, did you know that I was on the podcast
I was watching this weekend. Yeah, I'm still working through it.
Did you really?
It was my This Morning Makeup podcast today.
Well, here it is, baby. Make sure, guys, to give this a watch or a listen. It's available on Spotify, and it's also available, obviously, on YouTube. There is Brendo and I. The Markets podcast, we got into everything. We talked about, you know, Charlie Munger, God rest his soul. We talked about other major important things like crypto. We talked about Amazon and how it could, you know, really find its way onto the scene. We talked about AI. There we go. I like it. I'm not involved in the picture, but that's okay.
You're in the background. It's implied.
Sure.
It's implied.
Yeah. We talked about a lot of stuff. Make sure to check that out, guys. Long form discussion. No, like, 1 or 2 lines like we have to do at the big desk in the morning. Brendo and I delve deep into that bad boy. So give that a listen if you're interested. But yeah. The other book that I would suggest, hey, that's you and me right there.
I like the little apple with the book.
Yeah, of course, because the apple, well, everybody knows what the word is. The other materials that I use are the actual chartered market technician materials that I paid for, that kind of stuff. I don't think is available online for free unless you're able to, do your thing there, in which case I have nothing to do with that. I extract all the information from the first exams materials, not the second. I haven't even touched the second. So when we talk about chart patterns or when we talk about candlestick patterns, volume, anything else, a lot of that is coming from technical analysis of the financial markets by John J. Murphy and the actual chartered market technician materials as well. No copyright intended because they're same ideas. All right. I always take notes on all the books I read. I'll read it again with the notes open, says Rachel. Great idea, Rachel.
That's solid. Yeah, you can cross-reference and see what you noticed this time that maybe you didn't notice last time.
Absolutely.
I like that. That's a really good idea.
Absolutely. Peterson says, sure, you always feel like you could have had more gain, but it's fleeting. Always another day to trade. You're not wrong. I wish, that the feelings would be as easy as hitting a button and you'd switch them off. Sadly, it just doesn't work that way. So I'm going to say it again, practice, practice, practice.
Screen time. I know you're always
hey,
well.
Okay, all right.
I'm gonna switch it up, and now I'll say screen time.
I like that. Okay.
Balance it out. But yeah, no, I mean it is important. Like the more time you're actually able to, especially like in the wild, looking at charts is very different. And when you have a bit of skin in the game, or in my case, like paper trade skin, because I am still in the simulator. But yeah, so I think like being able to actually kind of watch the trade live sometimes too, especially once you've had like that learning opportunity, I think can kind of enrich the technical learning because you also have practical experience. Alex Davis says, homie shirt's about to rip. It's not, my friend, it's stretchy. Show them, Ram. I know you love this. Yeah, it's show them, Ram. It's stretchy stuff. Shout out to Winners, baby. Where I get Winners is great. Oh yeah. Winners is really great. Space between the mic and the button, Ram says. Oh, well, I'm showing some skin there, apparently. Well, we'll have to fix that after. Blackberry, Sharif Adira. Nassim Nichols Taleb wrote The Black Swan. Didn't read it yet, but I think it's the theory you were referring to. Huh, I didn't actually know that. Maybe I'll make a note of that. I'm a little familiar from this because I did, when I first started, I was doing some Coursera courses with, I believe it was Robert Schiller was the prof for that. So yeah, he brought up the whole Black Swan events quite a lot. So that, yeah, I haven't read the book though. I'd like to read the book. Another comment from Blackberry too. I think loss aversion is one of the reasons why really good trading ideas don't get implemented in the first place. And I think that's valid. Like sometimes you see a pattern and then you get cold feet or you get a little bit nervous and maybe there's valid reasons maybe it wouldn't work out, but the thing is, you miss 100% of the shots you don't take to to be a little cliche here and quote Wayne Gretzky, I believe. So I think that one's interesting. Also a question from Few Rhymes with AMC that I'm not sure I have an answer to, but I think it's really interesting. How do you think things like dyslexia affect someone's trading psychology? That's a really good question. I don't know. I really like that question. I think probably too your experience with any anything like that, like dyslexia, dyscalculia, like anything. I think it'll definitely impact your trading psychology and how you approach the markets. And I think probably too like it's probably individual experience a little bit too, like how you kind of interpret the markets and how you deal with it. But yeah, I mean I think I wish I had a better answer for you than that. But I think I mean like definitely whatever experience you have and whatever you bring to the market and to the trading is obviously going to impact your psychology in a different way. But I mean, I'd like to do more research on that because that's interesting and honestly not something I super thought about, but very interesting perspective. And thank you for bringing that. Absolutely. Couldn't agree more. It gets really nuanced when you want to, take psychological conditions and then ask how those specific psychological conditions are going to affect trading. I think it really is beyond our scope of comprehension. Well, mine, I don't know about yours, but out of mine anyway, I probably won't be able to opine on that. Well, yeah, I think because I think even like with stuff like dyslexia as well, like or dyscalculia, like any learning issues. I think it really like impacts people differently as far as I'm aware. So I think, yeah, I think it's like partially too, with any, at least in my experience, with any kind of experience like that, is it's really to each their own, and you kind of learn through time ways of dealing with it. So I think it would be interesting. I think I would say like trust your experience, and just, you know, check in with yourself and do what you need to do. But yeah, I'd like to do more research on that. I apologize that I don't have a better answer.
You don't have to apologize, Adara. Come on.
Yeah. Really interesting question.
Very good question here from Aries Stocks Market. When you say in the wild, what do you mean, Adara?
Okay, I wish I had an answer.
We both know.
I would say, yeah, I would say my interpretation is like when the market's actually moving, when the stocks are moving, like in the day. Like sometimes, like since I've been saying it, Sharif and I will say like in the wild.
I
like,
took it from you.
Yeah, like off air, right? But I think how I've interpreted how Sharif has kind of caught on like wildfire with it, which is fun, is that basically it's like when actually what's happening on a day-to-day moment.
Yep.
Like, so like if something's happened like yesterday, or sorry, not yesterday because that was Sunday, on Friday, that's not in the wild, that's already happened. But like what a stock is doing in this moment right now, and that could be on the daily, on the weekly, on the monthly, but what it's doing in this period, that's in the wild to me. So I hope that makes sense. That's kind of when I say in the wild, I mean like what's moving right now.
Yeah, and it comes up in the context of using the moving average indicators that we talked about last week. Prior to that, we were talking about chart patterns, and we would like to find you examples in the wild, obviously, so you can see it in real time. Sometimes it's a little hard to do, obviously. That means we gotta teach a lesson, trade, and look and scan the market for these chart patterns or for, confluence with some of the moving indicators that we were talking about. It's a little hard, guys. So when we can find the wild, all the better. And you guys seem to be really helpful with pointing us out, because oftentimes there, people will message in the chat, be like, is this a head and shoulders on whatever, Uber?
Yeah.
And then we'll have a look, we'll make an opinion, we'll give a comment on it, we'll make some suggestions about how you can view it. So yeah, when we say in the wild, guys, we're talking about live, we're referring to what we're talking about currently. So anytime you can help us with that, we'll take it.
Yeah, so and that's a good question, because it's just kind of a term I started using all willy-nilly without any specific definition. So I appreciate the question. And yeah, that's kind of, if anyone does ever see examples too in the wild, we always encourage, type it in and then we can kind of evaluate it together.
There you go. Emma Hamada. My tip that works for me for shutting off that emotional button, losing FOMO, is executing my plan. Seeing it work out, ignore the noise that exists outside it, no FOMO. Man, I couldn't agree more with you. Everything you said there was accurate. Executing in the way that you say you're executing for a lot of people seems to be hard. Otherwise, there would be a lot more success, I think, in day trading than there currently is. But what you're saying is absolutely accurate. Thank you for that comment. Michael Storm. Sharif, is there a way I can get your gateway cheat sheet? The gateway cheat sheet here is only relevant for Day Trade the World because the ID of the, the ID here that shows me the different letters is only Day Trade the World specific. What I can do is I can tell you about all the different gateways if that's what you want, but the corresponding letters are gonna mean nothing to you unless you're using a Day Trade the World platform. Peterson, yeah, I remember that book, Black Swan, was a decent read. I think he made some mistakes, though, in his analysis or calls, but nobody's perfect. Nobody is. Thank you for that.
Yeah. There's also, I really like this comment from Fee Rhymes with AMC. I think it's unrealistic to trade without emotion. I think the issue is more about understanding those emotions and learning to adapt to them. And I think, I totally agree, and I hope we're able to kind of come up with some tips and tricks to kind of help people with, you don't agree?
I don't disagree, but I'm not 100% in agreement. Can I tell you why?
That's fair.
When I was down 5 figures on my account in October, I was dead inside.
Okay.
Absolutely dead. And you have to be dead inside as a long-term investor.
Okay.
And even Charlie Munger talked about this. Stability, persistence, the ability to remain the same in the face of volatility is the real deal here, especially for long-term investors. You're not going to make, generational wealth is not made, quickly. It's made by holding for a long time. So I got to tell you, when I was down big, it was, the best thing that I could have done was just be neutral or nothing inside. If I felt emotions being down big, then, you know.
That's interesting.
I could have pulled the trigger when they pop back up and not let it run, or chose to cut my losses, chose to basically think about the L that I had now rather than the longer term picture that got me into the trade in the first place by seeing the deliveries, by seeing the potential for homes. I'm talking about Caterpillar, I'm talking about Lee, right?
Yeah.
All that analysis would have gone out the door
so
when I felt like absolute, you know what? Because I was down big.
Okay.
You see what I'm saying?
So yeah, so it's kind of about recognizing that the emotions exist and coming up with better ways to manage them?
Well said.
Okay.
Well said, yeah. But I don't know. Everybody's gonna be different, but you know, the one thing that, you know, my buddy and Alfred and I, I'm gonna keep referencing him, you know, he's the one that gave it to me when he was down big on his Tesla trade before the pandemic hit. And then guess what? You know, $250,000 1 year is what he made, right? Just on that one trade. He's like, yeah, you got to be dead inside. It may work for you, it may not work for you. I mean, that's just what I can say. All right, Mr. Love Shack. Sharif, I have dyscalculia? I don't know how to say that.
Oh, yeah, it's like the math version of dyslexia. Yeah, dyscalculia. I think you said it correctly, I think.
Did I? I have no idea. It's the first time I see that word. I'm sorry if I mispronounced it. And I use the visual charts for P&L and the ROR than I do with the numbers. Very interesting.
That's
I mean,
cool.
I don't think that there's any hard and fast rule. Whatever works for you and is effective based on your past performance, go with it, man.
Yeah, like finding creative solutions too, right? Like it's, you know, kind of like what I was saying. I think like everyone's gonna have a different experience with stuff, and if you can find a way to kind of help the market make sense for you and for trade, I think like that's very entrepreneurial. That's very
couldn't agree more.
There you go.
Absolutely. All right, just going down the list here. Anything else? Blackberry. Yes, he's always coming up with good, interesting questions. Interesting point in a way you have to separate your emotional from the rational to function perfect like that. A question could be if it's healthy for you. That's a very good question. Yeah, because maybe I think what you're trying to say is, you know, you're suppressing your emotions rather than letting them manifest and come to the surface, and as a result, you pay some sort of longer-term price, maybe in stress, blood pressure. I'm assuming that's what you mean. Look, I don't have the answer to that. Go for it.
I'm sorry, I just really enjoyed what I'm assuming Ramin just put in the chat here. Everybody makes mistakes. Everybody has those days. Hannah Montana was for real. So if anyone knows that, thank you so much for that. Blast from the past, and I hope some people enjoyed that in the chat, because I certainly did. So
yeah, Ram dropping hot fire today in the chat. All right, Ram. Just gonna start teaching this class, and we're gonna be out of a job. Let's see what. Yeah, careful, says Brendo. I heard you up there. Fu Magoo. That's a hell of a name there. Fu Magoo. It's cool as a tree topper. I understand my mind when it comes to fear, since I have faced death a few times and stayed calm. You know, I'd rather you not have faced death, but I do respect your experience and your opinion. Thank you for sharing that. Fumagu, a hell of a name, by the way. Ray Murmur likes your name. All right.
She does.
She does. All right, guys. Any other questions? We had about 10 minutes before we have to repeat it again.
I cannot believe we've already spent 50 minutes.
Yeah.
It's gone by so quickly.
It has.
But yeah, no, I think if there are any more questions, definitely put them in the chat. We love discussing the questions.
Absolutely.
And I think especially a lot of the chart questions were, I think, a bit more like true or false, right or wrong. But I think I'm really excited about
this is much more subjective.
Right, exactly. It's much more subjective, and I think people can have different opinions, but as long as you find a strategy that works for you, that kind of helps you manage the mental elements and trade to the best of your abilities and an area at which you are comfortable, I think that is, I think that's important. And so, yeah, any questions or any, you know, kind of points of interest here would be much appreciated.
All right, the ES is moving up here. And we're moving up nicely. We're almost 10 points in the money here as we move up, knock on the door of that 45.70, but there is VWAP coming up, and something tells me VWAP is going to be a little bit of a resistance point here. 45.69 is where I see VWAP on my chart. We'll see what kind of continuity you get. Obviously a counter trend trade, but I did really like that 45.50 level that I keep saying. It was a level that I really did keep charting every day at the big desk when I look at the future, and it was a level that we found quite a long period of support on. So we got right into that level this morning, making a 45.53 base over here. So we'll see what we get on that, okay? Ivan, Sharif, that means you don't admit you are wrong, never cut the loss. Look at CEI, look at CSCO in 2000. Never meet those highs 20 years later. Zamba, ba. The list is long. I think you're misunderstanding me. So nothing changed with respect to the fundamentals of why I got into the trade. Okay? For my long-term trades, the ones that I was referencing, the ones that I was down 5 figures on a week in October, nothing changed but the fundamentals. The only thing that changed was the price action. The fundamentals were still the same. But if I had looked at the current price action as opposed to reminding myself why I got into the trade, that the fundamentals were sound, I'd be down big rather than being up big on them. That's what I'm saying. I'm not saying that you can never change your opinion. Of course you can. If the fundamentals came out for Elite Auto differently than they came out last time when they were up 190% year over year on deliveries, I definitely would be looking at it differently. No question about that. So I think you're really misunderstanding what I was focusing on. I was trying to say, don't look at the price action if the fundamentals haven't changed, right? You got to stay the course if you believe in your investments, and conviction is the word I'd like to use there. Shout out to Ivan. Very, very good question by Ivan, though. Yeah. To be fair. All right. What positions are you in, Katina Man? JT37 asks. Intel short, Rivian short, Google short. There you go. Intel is the newest one, he says. All right. Bitcoin trader is asking you how long to stay in the trade is hard.
Yeah, I think it's going to come down to like your own kind of, I think maybe what you're asking or saying is it's difficult to know how long to stay in a trade. And I think for myself, I've had better, I don't want to use the word luck, I've had better success with that when I kind of have a more disciplined plan going into it, right? So I'll actually use the example of this ill-fated NVIDIA short. So I got in this because we were seeing lower highs. I got in kind of partway through the move to the downside. I just said if we make a higher high, I am outie. And then we did make a higher high, so I got out, right? So I think it's just kind of being able to react to movement. And if you have a plan ahead of time, then you're not having to constantly evaluate once you're in the trade. You just know, once this area triggers, once we leave this area, once we leave this comfort zone that I have predetermined, then I need to leave. But in terms of the profit takers, I think it's kind of the same, right? Usually if I'm in a situation where I'm waiting for a lower, for example, if the short had worked out, I would have taken part of my profit out of this 451. Why? Because that was the last level at which we achieved another low, right? So, and then I would keep a piece for the dream to see if we got lower. Thank you. Shout out to you for the piece for the dream. But yeah, so that's kind of what I would do for that. And I think, kind of having those strategies can help you kind of, think through a trade and have a plan, have a game plan, have an approach. Bitcoin trader saying, thank you. Yes, I panic sometimes to get out too early, LOL. I mean, me too. All the time. So definitely I get it. And I mean, I'm still very much learning. I think I know there's some people here in the chat learning still as well. Oh, yeah. And I think part of, just experience.
Or me and you.
Kind of, pardon?
So are you and
Yeah, well, I know, I definitely am, right? But yeah, and I think the thing is, from what I understand about trading, it's always kind of a learning process too, right? Because what I love about the markets as well is the markets are not going to be the same every day. There's going to be all these different variances, right? And I think it helps you kind of learn on a day-to-day basis and find what works and what doesn't work. And I think, having a plan before you enter the trade can help you avoid some of those pitfalls. In my experience, there we go.
Bang. Excellent. I would say that's a hell of an answer there.
Thank you.
The Piper, Sharif, those Bollinger Bands help you stay in a trade because you can see if you're still in one or within 1 or 2 standard deviations. Yes. Again, though, with everything else that we've shown you so far, whether chart patterns or volume or any indicator that we talked about, VWAP, MACD, the moving averages themselves, everything we've talked about. Look for confirmation. Try not to rely too heavily on one indicator or one chart pattern or one piece of information. Try to look for supporting evidence. When a matter goes to trial, oftentimes, unless there is direct evidence, direct eyewitness evidence, or direct, DNA evidence.
And that sounds so legal. I love it.
Yeah. Well, that's my background, right?
No, I like it. No,
unless there's direct evidence, what you're looking for is an accumulation of circumstantial evidence leading to, you know, a beyond the reasonable doubt result, right? In isolation, one of those pieces of evidence may not be enough, but added together, they seem to, you know, be persuasive enough.
That's a beautiful analogy.
Thank you.
I really like that. Yeah, I mean,
I'm here to please, baby.
No, I think, like, yeah, like just the ability to kind of apply the legal elements to this is really cool.
Yeah?
But yeah, very solid analogy.
Emma Hamada. For long-term investing, if you cross short-term noise, you can sell a bit instead of the full position. I did this in Ford because the UAW got more extreme than I thought. That's up to you. That's your strategy, and if it makes money for you, go with it. As long as you're printing. It may not make sense for me. It may not make sense for other people who hold true to their convictions. If there is no fundamental change in the data that they use to enter the trade, right? Price is short-term noise. It may be affected by things completely separate from the actual company itself, right? There is a, you know, wars can come out, or the Fed can do this or that, but the fundamentals of the company are sound. So I would say that to you, but if that works for you, it works for you. I'm not telling you to do anything different. Adam, that's why, oh, come on, Adam, you know that that's not the case. I just took a beak wetter there at 69, so about 10 points in the money right now on this MES, trade, letting this bad boy run. We broke through this resistance level over here, which was the trough, but now we're at VWAP, so resistance coming in possibly here. The trend changes, in my humble opinion, if we make a new high. Let's bring in the chart real quick. We have about 2 minutes until we have to restart the lesson. This is the level that I'm talking about over here that we broke above, but this is the white line, as you know from previous lessons, is VWAP. So I'm expecting there to be a degree of resistance around here. I'm going to be very excited, Adara, though, if we break through this 45.77, let's say 40.78, that will be a higher high, and that will have completely changed the trend. We'll see if we get there. You know, something tells me we may not make it up there today, but definitely off the bottoms. 45.50 still coming into play again. Yeah. By the way, I want to talk about a little bit about soccer quickly here. Arsenal won, but that's not the only thing I want to talk about, Dara.
Oh, it's not.
We won 2-1 against Wolverhampton Wolves, which, by the way, is a tough team. They beat City. They beat Manchester City. They beat Tottenham, yeah, last minute. They tied with Aston Villa.
Oh, and you guys beat them.
And we beat them at home. We had to beat them. And then Tottenham tied City, which means
that's weird.
Which is fantastic for us.
Go.
And Liverpool almost tied. Who were they playing again? Whatever. I forget who Liverpool was playing. Fulham. They almost tied Fulham. They won in the last second with a couple of goals. A couple of great goals there.
Look at that. That's really cool.
Yeah, in any case. I was very
Premier League updates.
Yes, exactly. Nick Dubb. What up, Nick? Thank you very much, Nick, for the $5 super chat, my man. Sharif, thanks again for what you guys do. I think the calendar of lessons is a great idea. Can you also look at TTD NILMN? Thank you. Yes, we will definitely look at getting that calendar for you. I know that was suggested by another viewer, and I think it makes an eminent amount of sense. I will look at TTD, and Adara will look at ILMN. I think that's Illumina, is it not? Is it Illumina? Yeah. So, okay. Trade Desk. Let's have a look at Trade Desk. Down on the day, it looks like it closed out at that 71.60 area. Let me put that in. I know this was on the watch list not that long ago, right? Because it had like earnings or something. Yeah, wasn't it?
Yeah, I think so.
Yeah, so let's look at the daily first and foremost. The daily, let me just remove this here because that bar, there we go. So now we get a good look at Trade Desk. Decent up move on the year. Looks like we broke a bit of that uptrend though at around when are we, like middle of October, which is I'm not surprised about that because that was a bad time for the market, and then we definitely held that trend line as resistance and moved down to 52. This is probably the what's it called day, the earnings day. You can just tell by the outlying volume when we came down to 52. Good move up. I would say look at that 83 level currently as resistance. I know we just got into 70. That's the macro view. On the more intraday view, yeah, a bit of a V-shaped recovery happening at the moment. Definitely resistance at that 70 and 3/4 level. That was the high in the pre, and then you're looking at real resistance at that 71.60 area. That's Friday's close. You may also encounter resistance at the whole dollar area because it is whole dollar, so 70 upcoming and about 40 cents on trade desk.
Yeah. Also, Illumina, looks like we could be making a higher high on the daily chart. Illumina, we had some weakness here, you know, kind of falling to the downside for a while here. I would call this a downward trend, as we talked about a couple weeks ago. But now we're seeing what could be a break of the high on the daily. So if we kind of decisively break above this 115, 116 area, I think the Illumina daily chart could get very juicy indeed. In terms of intraday, Illumina is also looking pretty fine. I'll pull up the 5-minute because this is gorgeous. And this is an upward trend here on the daily, on the 5-minute chart here for Illumina, like just a beautiful upward trend. Overall, this name looks like we've had some pretty solid recovery. Illumina looks pretty solid by my analysis. Yeah. Also, there was a chat earlier too that I wanted to shout out from Lincoln. I think this is what we were talking about, like, you know, kind of trading earlier and knowing when to get in and out. A person also has to decide who they are: a swing trader, a day trader, or a hodler. And if you can't decide, have different accounts for them. Oh, a holder.
Yeah.
That's what that is, sorry. Yeah. And if you can't decide, have different accounts for them.
That's actually a good idea.
That's a really good strategy, right? And I think, yeah, very interesting times. But yeah, so I appreciate that insight as well. And yeah, I think like we've been talking kind of for a while too about the role that personality plays in trading. And you have to understand yourself to kind of know how you want to trade and what strategies make the most sense for you. So I really appreciate that insight.
Okay. All right. Let's restart the topics again. Well, we already have only one topic today. Bit of a complicated one today, guys. That's why we're only doing one of these bad boys. Adira, would you mind starting us off?
Yeah, let's start us off. Also, so apparently HODL is hold on for dear life. So thank you people in the chat for telling me.
It.
I was not aware of that. Learning new things every day. So
awesome.
Appreciate that. So let's talk about prospect theory. Which basically assumes that losses and gains are valued differently, and thus individuals basically make decisions based on perceived gains instead of perceived losses. So this is also known as loss aversion theory, which basically, kind of how it sounds, the idea that we fear losses more than we crave gains. And the general concept is that if two choices are put before an individual, both equal, with one presented in terms of potential gains and the other one presented in terms of potential losses, you'll basically choose the option for potential gains, even though they are literally the exact same. So it's all kind of psychological, right? Which is fitting for Psychology Week.
Right.
So how does this actually work, though, like in practice? Prospect theory is part of the behavioral economic group, which is basically describing how individuals make choices between probabilistic alternatives when risk is involved and the probability of different outcomes is unknown. So yeah, I think the aspect of risk here cannot be overstated, especially when we're talking about day trading, which is inherently pretty risky.
Yeah.
So this theory was basically formulated in 1979 and further developed in 1992 by these two dudes, Amos Tversky and Daniel Kahneman. I am so sorry if I'm pronouncing either of these gentlemen's names incorrectly. But basically, it's kind of deemed more psychologically accurate in terms of how decisions are made when compared to expected utility theory. And I mean, there's like so many different kind of psychology trading theories, right? So it's kind of whatever flows your boat. But this one is particularly interesting and I think very applicable. So the underlying explanation for an individual's behavior under this theory is that because the choices are independent and singular, the probability of a gain or a loss is reasonably assumed as being 50-50 instead of the probability that is actually presented. So essentially the probability of a gain is perceived as greater even if they are like exactly the same. Like the probability is the same, but if it's presented in terms of gains, you will assume the probability is greater. It's basically just a fallacy. Tversky and Kahneman proposed that losses cause a greater emotional impact or toil or toll on an individual than an equivalent amount of gain. So given the choice presented two ways with both offering exactly the same result, an individual will pick the option offering perceived gains. So for example, assume that the end result of receiving $25. So that's either way, you're going to get $25, right? But one option to get your $25 is to be given the $25 outright. So if I just handed Sharif 25 bucks. The other option is if you give, like, for example, if I were to give Sharif 25 bucks and be like, oh, but you have to give me $25 back, right? So in the end, either way, Sharif is getting $25.
Woo!
No, yeah, he's very excited. No matter what, he's getting $25, right? But basically, the first option is presented as gains because he gets the 25 outright. But the other one is presented as a loss because he has to give back $25, even though in the end, he's still going to end up with $25. But most individuals are more likely to just choose to receive the $25 outright because a single gain is generally perceived as more favorable than the initially having more cash and suffering a loss, even though you're still getting $25.
Yeah.
It's a really fascinating concept. But yeah, so there's different phases of prospect theory as well. So we have basically it asserts that all decisions are made through a two-stage process.
Bang.
And so instead of considering all available information and possible options, which would not really be possible, humans use a two-step process to narrow down the most important information. And these steps are described as the editing phase and the evaluation phase. Very cool. So the editing phase is basically where people decide what information you're going to use in the evaluation stage. So decision makers will use basically mental shortcuts. And it's really cool because this all seems to be kind of subconscious as well. You know what I mean? So these things happening that you're not even really cognizant of. So decision makers use mental shortcuts to assess which information is important and what options are available. So basically two mental processes happening at the same time. And then they also, at this point, decide which outcomes are most desirable and even rank priorities. Like, oh, this is my, my best option, second best, third best, et cetera, right? Very interesting. And then the editing phase is also important because it basically introduces biases that emerge later in the decision process. So this is when these biases first rear their ugly little heads. And if an individual doesn't consider certain unlikely outcomes, or if you make an incorrect assessment during this process, it's really you can't really go back from that point, right? Or it's a little bit more difficult to. And once you've made these editing decisions, you've sort of set the stage. So then suboptimal trading decisions might be made later down the line, and that's where stage numero deux comes. Dos, I combined languages there. Whew. The evaluation phase. So this is the stage where people actually make their final decisions based on the assessments that they made in the editing phase. So this is where you take the editing phase and you actually kind of put it into practice.
Bang.
People weigh the probability of each outcome and then they take actions based on the perceived likelihood and desirability of each outcome. So it's important to note that these decisions aren't really based on rational calculations. So as I said, like a lot of it is kind of happening without your awareness, without your knowledge. It's all happening in your brain psychologically, subconsciously, et cetera, et cetera. Prospect theory posits, great word, that people tend to be risk averse when the stakes are high and then risk accepting when the stakes are low. So yeah, basically the sad thing is when you have more to gain, you actually get more nervous because we're inherently scared of gains. It's very sad. I mean, it's funny. It's sad.
Well, I mean, funny, not funny, ha ha.
But it's like funny, like interesting. I know,
yeah, exactly.
I'm just being goofy over here. But yeah, so in other words, basically people make choices that minimize losses instead of maximizing gains. So it's a very kind of, I guess, masochistic viewpoint. But yeah, looking at the market in terms of...
And someone wrote that in the chat, actually.
Really?
I love...
Yeah, it's a great word.
Which I think I agree with.
And I agree. Like, I think it is. There's a level of masochism, right? And the thing is, we view it as trying to protect ourselves. We're trying to, presumably protect ourselves from losses, but in the end, we're actually harming ourselves from gains. Yeah, so just kind of interesting there. And what are some of the characteristics of prospect theory? So prospect theory suggests that humans tend to prefer certainties over probabilities. So let's say you have a choice between being given $50 and a 50% chance of winning $100. So I said earlier, I was like, oh, I'll take the 50 right up top, right? And Sharif was like, well, no. Because yeah, most people will take the 50 as my initial inclination was to do, even though the expected value of the two options is exactly the same. Like if you math it out, you're going to come to the same little conclusion there. Prospect theory also asserts that certain people underestimate or even ignore outcomes with a low probability. So if you think something is really unlikely to happen, you don't even consider it. But then that kind of, that's unfortunate because then we can have black swan events, which are literally characterized by the fact that they are so unlikely to happen and then they happen. So if you're not preparing for those abilities, you can kind of put yourself in a sticky situation. You can end up in a bit of a quagmire because you haven't prepared and you've only basically set yourself up for, for these different, these supposedly higher probability events. So how do you overcome these biases? So understanding the actual theories can help you overcome, what's actually presented here. make more rational choices. So an investor who is aware of their bias towards high probability events can compensate by giving extra consideration to low probability events.
Exactly.
It also helps to reframe possible outcomes in a way that reduces the impact of cognitive biases. So instead of thinking in terms of gains or loss, which is really easy to do, especially when you're trading and you literally have mathematical confirmation of your gains or losses, you can instead think of terms of the value of expected outcomes. So I guess a little bit more cerebral, right? A little bit of a broader picture way of looking at things without using the present as a reference point. And this can reduce your loss aversion bias. And so what are the outcomes of this theory, or at least posited by this theory? So according to Tversky and Kahneman, the certainty effect is exhibited when people prefer certain outcomes and underweight outcomes that are only probable. So like, with black swans, like we were talking about earlier, the certainty effect basically leads individuals to ignore or to, basically leads to avoiding risk when there is a prospect of sure gain. It also contributes to individuals seeking risk when one of their options is a sure loss, which is, again, really sad and just kind of about us being a little bit masochistic and maybe undervaluing ourselves and our possibility for gain. Here we go. The isolation effect occurs when people have presented two options with the same outcome, but different routes to the outcome. So basically, either way, you're gonna end up from point A to point B, but it's like, oh, would you rather take like a scooter or would you rather take a bicycle? Either way, you're gonna end up at point B, right? The options have the exact same probability of occurring. Maybe that was a weird metaphor, but hey. But yeah, in this case, people are likely to cancel out similar information to lighten the cognitive load. So basically, you have to think about less. And their conclusions will vary depending on how the options are framed. So here's an example of prospect theory. So basically, consider an investor who's been given two pitches for the same mutual fund. So the first advisor, so I'll use Sharif now as the example here. The tables have turned. How the turntables showed in the office. But yeah, so let's say I present this fund to Sharif, and I'm like, hey, this mutual fund has an average return of 10% for the last 3 years. So for the last 3 years, 10% return, right?
Money, money.
And then, yeah, money, money, money. And then the second advisor, so let's say Sean, sorry to use Sean's name again here, is coming in here saying that the investor, basically telling Sharif here, that the fund has had an above average returns over the last decade, but it's been in decline over these past 3 years. So prospect theory says that even though Sharif's been pitched the exact same thing from Sean and myself, he's more likely to go with what I'm pitching, because I'm saying, oh, over the last 3 years, we've had these gains, when the gains could literally be exactly the same.
They are.
Hypothetical Sean is just presenting it from a wider perspective, whereas I'm only focusing on these last 3 years, right? So it's about recency bias as well, which is, I think, really interesting there too. The investor is more likely to buy the fund from the advisor that expresses the rate of return only in gains, whereas the second example actually presents the fuller picture. So it actually gives you a better idea, and it's a better pitch.
There you go.
All in all. So what does prospect theory actually mean? We're talking all these complex terms. Basically, prospect theory says that investors value gains and losses differently. So we put more weight on the L's than we do on the wins. And so if investor is presented an investment opportunity based on potential gains, and another investor is based on presented an opportunity in terms of losses, the investor is going to choose the investment where gains are seen as more probable, even though literally probability is the same. It's the same. But why is this important, right? So it's useful for investors to understand their biases, to kind of work through them in a cognitive way, and where losses tend to cause greater emotional impact than the equivalent gain. And prospect theory also helps to describe how decisions are made by investors. So like I said, I think when you're more cognizant of events and probabilities, then you're more able to evaluate them and maybe make some smarter choices.
Very, very good. Very well said. Thank you for covering that. The Katina man put in the chat, if you guys have questions for him about this, because we want to know, a lot of people were asking earlier on when I was reviewing this whole thing, how does Sean deal with this? How does Sean deal with that? You guys see him. He trades the open, essentially the most volatile time of the day when things are moving, $2, $3 in one 1 minute candle, right? You got to have nerves in order to be able to hold that. So we're going to get the Katina man to chime in. He's scarfing down his salad at the moment. He's put him on, baby.
I love the
there
salad
it is.
display.
It's all done there. There you go. It was a good salad. It typically is a good salad, I got to tell you the truth. So yeah, we'll get Sean to chime in a second there. But guys, try to internalize what she's saying. Essentially, people are more prone to be, number one, looking at a positive spin rather than a negative spin on this. And number two, they are more prone to looking at the more probable rather than also focusing and giving due weight. Giving due weight to the less probable, but also possibly probable. Probably didn't make a whole lot of sense there.
Probably probable.
Probably probable. We get A's in our English on here. But quite frankly, that's exactly what this whole thing is about, right? Understanding how your biases lean so that you can make the right decision when moving onward. So we're going to review that in a second. Again, Nicole Harris, shout out from Hotlanta. Shout out, Nicole. Thank you very much for the $5 super chat. She says, Hut 8 is up 300%. Yes, it is. Brendel's trying to sell it. I was trying to talk him out of it. He doesn't want it. He did? I thought he was still, no, he sold, eh? Okay, well, Brendel's out apparently, says the Katina man. Any other minor stocks in position, BT, CLSK, obviously come to mind is Mara and Riot.
Coin, or is Coin
that's not a mining stock, it's an exchange, yeah. But that's fine. It's a Bitcoin,
same in the same
cryptocurrency. Obviously, I'm thinking, again, like I said, more on Riot. On mine, I have some older ones. I have Solo on here. Is this a mining-based company engaged in design, manufacturing of electric vehicle? What the hell is this doing here? Solo is not even... Hut 8 split 5-1, yes. And I did actually see that on the chart, by the way, Nicole. I'm looking for some other stuff for you over here. I'm not trying to give you any... trusts. I have OBTC, which is a Bitcoin trust. That's probably when you don't want that. I have GBTC as well, and then BITO. That my cryptocurrency watch list is not so extensive. BT, Riot, Mara, Coin, MicroStrategies. That's really it. You know, I'm not really in the gamut of Bitcoin trading. Sorry about that, Nicole. Couldn't help that much with any other ideas. Paulie D, Sharif Adera. I find it very useful to refer to old Day Trade the World education videos here on YouTube. I find the old trade reviews to be a great benefit. Thank you very much for that great segue. It allows me to show you how you can go into the YouTube channel that we have here and find old videos.
There's a lot of helpful stuff on there, like even for myself, like looking back and understanding the markets and everything.
So here's the way to do it. You come into the YouTube channel over here, you go to videos, and then there is this magnifying glass. You hit that bad boy over there. Let's say I want to search for VWAP. Okay. You type in VWAP, not GVWAP.
GVWAP.
Oops, I typed it wrong like a dum-dum. There we go, VWAP. And then all of a sudden, Neil's great, gorgeous face comes up on there.
Thumbnail.
There you go. Trading VWAP for huge profits, and he traded a nice trade there on Plug a couple of years ago. Yeah, isn't it ever? So yeah, using this search function on our YouTube page, a great way to kind of narrow your search down to see how Sean, Neil, Brendan, other traders who have traded on this channel did or use that particular indicator or whatever topic you're looking at. Make sure to use that as much as you can. Thank you for reminding me about that, Paulie D. Shout out to you. All right, moving down here. Let's get to some actual questions here with respect to what we're talking about. BITF is worth watching, says hit Uber37. BITQ says Ozan. I'm assuming all these are responses to Nicole's question. So there you go, Nicole. Some suggestions coming in.
Helping from the chat.
Yeah, always. I love the chat's contributions. They're top. Renata is apparently long 235 on Tesla, and she's printing $2.50 in the money. Shout out, good trade there, Renata. Maybe more trading, less cat pictures on your Instagram.
What?
Yeah, she knows what I'm talking about. Ian David taking a nibble at NVIDIA. Hog Rider. Hog Rider is long as well, something or another there. Tesla breaking out now, 237 says Hog Rider. Shout out to Hog Rider on that. Adam DeLuce, could Trader TV in the future possibly offer 3-quarter trade suggestions at the beginning of the day and the chat votes, or three to four trade suggestions, I'm assuming that's what you mean, Adam, at the beginning of the day, and the chat votes on the favorite option, obviously small risk, I will definitely move that up the hierarchy and see how they feel about that idea. Thank you for that suggestion, Adam, always coming in with hotlines there. I mispronounced this person's name. It's Yatube7. All right, Yatube7. Sounds good. I shall call you that from now on. Thomas Johnson. I was about to say Thomas Jefferson there for a second. Yeah.
Very different kind of conversation.
Completely different, right? We will see movement on SoFi with shareholders meeting today. I don't know, brother. I mean, if I knew, they called me Sharif Adamus or something like that.
Sharif Adamus.
No, but let's have a look at SoFi for him, right?
Yeah.
Fair question there.
I just like that nickname.
Right. SoFi. Let's see what this bad boy is up to on the day. Been a good look for SoFi lately. New highs. Let me just go to the daily chart here, see where we're at. Okay, so we're still in a downward channel. I'm still, a little bit suspicious. It looks like we're breaking through the downward channel if we already use the closing prints as the main thing here. But I gotta tell you, I'm gonna need to see a higher high, right? Even though you're breaking through the downward channel, the higher high to me is the most important of the bunch. And the higher high comes vis-a-vis an 850 close. I mean, the best case scenario for me is at a close above 9.25. That takes us through the September highs there that we made, because it's been incrementally lower highs and lower lows. You don't need to be a super chart technician to see that. I'd like a 9 and above, or 9.25 print, a 9 print above that level on a closing basis to really get me excited. We'll see what we do, but it's been a good few days since November 22nd. We've been moving up incrementally, but I still say maybe locked within that same downward channel trend. We'll have to wait and see how that ends up panning out.
I have a question too, actually.
Absolutely,
if you don't mind,
yeah, go for it.
So I guess what would count, sorry, I just have like the chart up again.
Yeah, let me just put in the ticker so everybody can follow along. Go for it.
Yeah, sorry, just, So I guess at what point, like, I guess what are we counting as like a low? So I guess if you go like, so we had that.
Oh, here we go.
Well, sorry, I mean like for like, I guess like, so a higher high, are we going from there or are we going from there?
Sorry, okay, so.
Yeah, so I guess from what point are we marking a new high?
Well, to me, the highs really define themselves. This is a crest for me.
Oh, okay.
And then we made a big move down. And then here's another crest.
Oh, okay, so it's just the ones that are within the channel,
there
those count as the crest.
Yeah,
okay, thank
remember
you.
when we talked about channels?
Question. Yeah. I just wanted to like make, because I wasn't sure if like the little baby ones counted, so that's just why I wanted to clarify.
Fair.
But thank you, I appreciate that.
Yeah, that's what I see there. So, I mean, on an intraday basis, anything can happen, but you can ride these ones on a nice trend basis, and I think that that's what I'd particularly look for here on SoFi. So shout out to you on that. B Leach Baba going, apparently, according to B Leach Baba. Shout out to Ian. Yeah, it is going. Just broke through that 73.50 at high a day, 73.57 high on Baba. Still down on the day, 0.2% though. Am I seeing any new? Oh, here we go. What's going on with Baba Stock Monday? Stock is trading lower on Monday in line with the broader iShares, the FXI, which is a Chinese ETF. The company lost its title as China's most valuable e-commerce company to PDD, an 8-year-old competitor. Dang, Baba got, well, man, I got to tell you, PDD is an absolute rocket.
Yeah, we were having this conversation.
Yeah. Well, it owns Temu. I even went on Temu, the Temu app the other day.
Really?
Yeah, I was trying to find, these badges for my car, these Jaguar badges that I could like put on the cup holders. They illuminate and they kind of light up the cup at night. So Temu had them in there. They look super cool. Yeah, it was really nice. Baba stock has lost 20% of its value year to date, while PDD has gained 72. So yeah, Baba has been having a tough time as of late. But yeah, on to the day, it is at highs. All right, BlackBerry, but you could make $1.50 on SoFi before reaching that old high. Why wait for the distant old high? Great question. I think that's a fantastic question. Look, you can get in here and you could watch it make lower lows. And that's the only thing that I'm waiting for. I'm waiting for confirmation that the trend has changed. What I see is a downward channel with lower highs and lower lows. I see a nice move up as of late, but I saw that before. Come to the chart. When we had this crest up here and then we moved down, what did we get? We got a nice move back up. 1, 2, 3, 4, 5, 6 days in a row. And then we found resistance at the upward channel. We moved back down. We did the same thing, just less days, but more aggressive move up. So to me, you don't have confirmation the channel is broken. If you want, you can get in at the lower end of the channel, right? And then have your stop through the break. So I would say it's a little bit dangerous to take it through the upward channel break, especially if you don't have confirmation of a new high. What I would wait is for both. You get the decided upward channel break, an established trend that takes us back to August 1st, or you get in at the bottom when you know where your stop is going to be, the making of a newer low, and you're out. So I would say it's a little bit late to channel trade because we're breaking through the channel. What I'd wait for now is the making of a higher high. That's just the way I trade. But yeah, you are absolutely accurate in asking that question. You leave a lot of money on the table with a lot of these strategies, and that's just the nature of the beast right there. All right. All right. Let me see. Getting ready for Temu to harass you. They are so annoying. I uninstalled until I want to order. They send too many notifications. Turn off the notifications. You can do that now with the new iOS update, iOS 17.
I think a lot of things too you can turn out. Like, like I have an iPhone 8 and I can still turn off like selective notifications.
Yeah, exactly. I turn off notifications all the time.
Yeah, sometimes you just need to. Yeah.
My friend Hashem is watching this stream. He just he commented on what I was saying. Less cat pictures, more trading. Yeah, Renata. Even my friend Hashem tells you less cat pictures, more trading. Kidding, of course. We're just bugging you, Renata.
That's pretty fun.
Futuristic says Carvana is taking off. Let's have a look at Vana. It was already on the watch list today. It was an upgrade.
It was, yeah.
And nice move up here for Vana, breaking through 40s. Max back there. Max, are you looking at Vana? He's not looking at Vana, guys. Sorry. So Max, the mad one, is not trading Vana on the day, but it is near highs, 41.25 there. Broke through view up, a bit of a hold at 38.5, but good look for Vana. I got an upgrade today from who? Let me tell you real quick here.
JP Morgan.
JP Morgan, underweight to neutral
25 to 40.
There you go. I talk about eidetic memory.
Yeah, I actually do have
25. Do you really?
Yeah.
25 to 40. I just took a shot in the dark there. I didn't actually know. The only reason I even know that is because of. Can you guess?
Is it because a certain character from a sitcom you really like also has it? Yeah.
Sheldon Cooper has an eidetic memory, or so he's told.
I think that's how I kind of like realized I had one too, was through that show, because the show was coming out when I was a kid, and people were like, do you know this? And I was like, oh, that's interesting, yeah.
Right.
So cool.
Hampton's Trader, Samsung or iPhone? iPhone. That's just for me. I'm not judging anybody else for their Samsung choice. I'm sure that Samsungs are great phones, so don't get at me, please. Is Max going to get back on the show? No, Max is doing his thing back there. He's printing on that desk. The Hayes records, 2 of 3 green days, but I sold my last winter call way too dang early. I'm sorry, Hayes, but hey, man, you printed. How can you complain? But Vana is printing here, baby. Let's come back to Carvana. Yeah, it is at highs, 41.70. You got that big dollar move up, that 40 hold, and now we're knocking the door of 42. So a lot of movement here in Carvana on the day. We know that this is a heavily shorted name. I don't have the exact short float at the moment. I got to load up trade ideas for that data. Give me a second here, but we know it was in the 40-some-odd% range. I think it may be, pardon me, a little bit lower than that now. I think Neil checked it out last week and it was just a smidge lower. All right, Trade Ideas has loaded successfully, so we're going to look at the Carvana short float over here, and it is at 36.94, 37% short float. That is a decent amount to be short. We know it's been a bit of a downtrend lately, so where the shorts have instituted their new positions, hard to tell, but on the daily chart, we can kind of just take a little bit of a guess. We know that there's definitely shorts at that $50 level, no question about that. We've been having trouble with that 50 going back all the way into early July. Mid-July, pardon me, and then multiple rejections off 50 in the subsequent weeks after that. So something tells me there's a whole bunch of people waiting at 50 and maybe a little bit above that as well. We'll have to see if we make it up there. But Vana is absolutely pumping to the high side now. We're knocking the door of 42. We're up 19% on Vana, and it keeps going.
Gosh.
Yeah, very strong on the day. Lincoln, for day trades, I find buying oversold RSI pullbacks on the 15-minute chart in the 1 hour time frame to be very lucrative on the run up. Very interesting strategy, not one that I haven't heard used before. I've heard a lot about it. However, my use for RSI a little bit different, as I use it as more of a divergence indicator between it and price action, as opposed to a confirmatory indicator to take oversold and overbought conditions. But hey, if it works for you, keep killing it on it. Print it, keep taking it till it doesn't work anymore, literally. That's what I have to say to you about that. Darwin, are they good for old man hands? Says Tony.
I think it's the foam. Yeah,
that's hilarious.
That's a good. I saw that and I was like, nice.
I always say old man hands can hang, right? That's the thing. All right.
Callback.
Let's restart the lesson a little bit here, because we got to really stay focused on the teaching aspect of things rather than the trading aspect. Let's go through this one more time.
Let's do it.
What is prospect theory, otherwise known as loss aversion theory? And that should kind of indicate to you where we're going here. Loss aversion theory. It assumes that losses and gains are valued differently by people, and thus individuals make decisions based on perceived gains rather than perceived losses. Individuals make decisions based on perceived gains rather than perceived losses. Okay? The general concept is that if two choices are put before an individual, both equal, both choices being equal, with one presented in terms of potential gains and the other in terms of potential losses, the former option, meaning the one with potential gains, will be chosen. The perfect example Adara made earlier when she was covering this topic is the mutual fund that's presented to her by me and the one presented to her by Sean. If I pitch it as we're going to have, we've been up 10% in 3 years, whereas if Sean says we've been up substantially over 10 years, but the preceding 3 years we've been down a bit, she's going to choose mine as opposed to Sean's, even though they're both the same. And I just got a print there at 45.75 on the future, so we're really moving up here on the MES. Sorry to digress, but we have been we based out nicely right in front of that 45.50 area, and now it's been 20 points to the good now off that bottom. We continue to print. 45.50 was the area that I charted umpteenth amount of times at the big desk as a support level for the ES, and it held out really nicely today. So let's see what we get on that. It looks like
a roundy face.
Hey, right? I bet you if I looked at the 5 or even like the 15 or the 10, it looked like a V.
Oh, yeah. V-shaped recovery.
All right, let's keep going. How does the prospect theory work? Okay. Prospect theory belongs to a bigger group called behavioral economic subgroup, and it is basically a body of psychology that deals with investing, with trading, with different economic relationships between humans and the economy. It describes how individuals make a choice between probabilistic alternatives where risk is involved and the probability of different outcomes is unknown. Okay? This theory was formulated, as Adara says, by a great individual named Amos Tversky and Daniel Kahneman. I hope I didn't butcher that last one, but he's not here, so who cares? Okay? The underlying explanation for an individual's behavior under the prospect theory is that because the choices are independent and singular, the probability of a gain or a loss is reasonably assumed as being 50-50 instead of the probability that is actually presented. So people have this desire or this instinct to look at things as a 50-50, and this goes back to what we talked about earlier about people really focusing more on the probabilistic outcome rather than also taking the less probabilistic factors into consideration. Tend to focus more on what is more likely to happen rather than also accounting for the factors that are less likely to happen. And you know what comes to mind here is when a person is presented with surgery. You're told what the risk factors are, what the likely outcome for each side effect or bad outcome is. Same thing when you're prescribed the drug and you get that leaflet from the pharmacy, risks all the side effects, right? What you're more likely to focus on are the more likely side effects, or the fact that you're unlikely to have some of these side effects, rather than focusing on what the odds are of you getting them. I think most people would look at that.
Huh, that's interesting. That's a good analogy.
Right? Tversky and Kahneman proposed that losses cause, and I couldn't agree with this more, that losses cause greater emotional impact on an individual than does the equivalent amount of gain. So given choice is presented in two ways, with both offering the same result, an individual will pick the option offering the perceived gains. For example, assume that the end result of receiving $25. One option, you're being given the $25 outright. The other option, you're being given $50 and then you have to give back 25. No difference. You end up with 25 bucks, right? The utility of the $25, exactly the same in both outcomes. However, individuals, according to the study, are more likely to choose to receive the straight cash of 25 rather than being given the 50, because a single gain is generally observed as more favorable than initially having more cash and then suffering a loss. And I kind of get that. I mean, I know that I don't want to suffer the pain of a loss. I mean, we've all been there, right? We've all been there where we've all suffered losses. I'd rather, take the 25, not have to suffer a loss, rather than being given 50 and then suffering a loss. So I can see why people would do that, but there's no logical, no rational reason for choosing one over the other.
That's a good way of putting it. Like, it literally outcome exactly the same. I mean, giving someone 50 and being like, give me 25 back is like weird, unless it's like a weird test, like a psychological test. But it's still a very interesting concept. And I think, and also, so there's something in the chat here too that I'm just only bringing up because it connects back to what we're saying. John Sturdivant here saying they should talk about how it's hard to take a loss, thus a small loss turns into a big loss. That's my biggest challenge. Thank you so much for saying that, John. And I think that really connects with what we're saying here too, right? Where basically, you kind of have to, it's kind of about like, planning a little bit in advance, and it goes back to what we were saying in risk management as well, where if you kind of, plan and you have a set amount of losses, then you can avoid hopefully bigger losses. But also, I think psychologically, as we've been talking about all day, we are pre-programmed as people for some reason to kind of be more willing to take losses than we are to take wins.
Yeah.
So it's definitely not just you. It's like a psychological kind of bias and a fallacy here.
I agree.
Yeah.
Moving on, there's different phases of prospect theory, as you can probably imagine. All right. Prospect theory asserts that decisions are made through a two-stage process. Instead of considering all the available information at your disposal and the possible options, which is impossible because we can't really know what all the possible outcomes are, right? Because there's any umpteen things that could happen in the market in the intervening period when we're invested. Humans use a two-step process to narrow down the most important information. Seems logical. These steps are described as the editing phase and the evaluation phase. Editing phase and evaluation phase. The editing phase, what the hell is that all about? The editing phase is where people decide which information will be used in the evaluation stage later on. Decision makers will use mental shortcuts to assess which information is important and what options are available. They also decide which outcomes are more desirable. Let me guess, they want to make money. And even rank their priorities. The editing phase is important because it can introduce biases that merge later in the decision process, for sure, right? If I'm looking at a particular equity, right, I'm likely going to have biases, whether learned or perceived or taught, right, by somebody else. I'm likely going to have biases, okay? Quick digression here. There was a judge in Guelph. He was a criminal court judge. Sadly, this judge lost his son in a drinking and driving accident where a drunk driver killed his son, okay? Anytime there was a criminal case in front of this judge that involved drinking and driving, he convicted without exception. He was then later reviewed by the Judicial Association, and he was removed from ever hearing any drinking and driving cases from there on in. Yeah. He had a built-in bias because of what happened to his son. I'm not telling you that trading is going to have such an extreme reaction, but if you take a big L, if your account takes a monster hit, you may have some program biases in there that may prevent you from digesting the information objectively in the future. This is a reality of human nature.
Yeah.
Okay?
It's a really, really, really good analogy.
Thank you.
Yeah, and I think it's like the same with, like, in terms of, from what I'm aware of the legal process with voir dire, why they do vet juries to kind of, you know, make sure that you don't have any biases, and so they'll ask questions that are kind of vaguely, and I know this because I did, like, you know, criminology and a little bit of forensic psychology in undergrad, but so they'll kind of vet juries to make sure that they don't have any biases they're not aware of.
100%.
The thing is, I'm sure that judge wasn't intentionally doing this, like, you know, maybe on some level, but I think, you know, a lot of it's subconscious, so we have to kind of deal with the subconscious elements in order to affect, like, you know, kind of get rid of those biases, and I think
100%.
that's absolutely the case in trading. So I appreciated that example.
No, for sure, and thank you for adding that, because voir dire, very, very poignant example there. We're not going to get into voir dire. It's a trial. I just
thought it was an interesting kind of analogy there. Yeah.
I'm just looking to see where I left off. Okay. If an individual does not consider certain unlikely outcomes, you have to consider the likely and the unlikely, okay? Or makes an incorrect assessment of the outcome's probability, they may end up making suboptimal decisions later on. And that's a nice way of saying suboptimal, is a nice way of saying, you know what, the trade, the trade, all right? The evaluation phase. The editing phase is just what we went through right now. Now we're going on to the evaluation phase, how we make the decision based upon the information that we acquired in the editing phase, or that we narrowed down. This stage is where people make their final decisions based upon the assessments made in the editing phase. People weigh the probability of each outcome and take actions based on the perceived likelihood and the desirability of each outcome. Another issue that's quite subjective and individual, the desirability. You need to factor that out. Obviously, you want to print, but that should not count at all in your decision-making process. The fact that you want to print, it should not entice you to get it. Obviously, you want to print. That should go without saying, but the trade should be made objectively. It is important to note that these decisions are not necessarily based on rational calculations. Prospect theory posits that people tend to be risk averse when the stakes are high. This actually caught my attention. People tend to be risk averse when their stakes are high and risk accepting when the stakes are low. Kind of seems, you know, makes sense, right? If I got more on the line, I'm likely to be a bit more nervous or risk averse. I got less on the line, I'm likely to have a bit more appetite for risk. I can get that. In other words, they tend to make choices that minimize losses rather than maximize expected gain. And that is a byproduct of thinking that way. By choosing to want to minimize your losses, right? Trading, you know what? Sean said a really good phrase last week. A scared trader is a deficient trader. And I think this plays perfectly with what this theory is saying. In other words, they tend to make choices that minimize losses rather than maximize expected gains. Let that sink in. All right. Anything to say or to add before I go on?
I actually kind of do have something that I think is interesting from what you're saying. Like, you know, how we're all kind of motivated by wanting to print, but that shouldn't, like, you know, impact our biases and how we make trading decisions. And yeah, I actually think it's kind of an interesting, it's almost a little fallacious in that we're, you know,
that's fantastic,
basically making decisions motivated by our want, you know, to, like, you know, make money, or in my case, simulation money, as I am still in the sim. But so we're motivated by wanting to have these, like, great A+ trades.
Yep.
In our pursuit of these trades, sometimes we'll leave, you know, we'll completely forget to think about it mentally. And, you know, and then, so I think sometimes it ends up being this fallacy where in our pursuit of making money, we actually, like, forget the concepts that would help make more money. That's kind of my takeaway from what you, I just thought that was interesting.
Thank you for that. You know, absolutely.
To add that in there.
And Adam dropped us a hotline in there as well. Think of it like this, he says. If you only win the $25, you win $25. That's, you know, self-explanatory. But if you win 50 and lose 25, you earn 25 and you learn to lessen 25 plus a lesson outcome to. Very well said. And there's an expression that between traders that we often say on the floor here. You either win or learn.
I've heard that.
Have you heard that?
I feel like I have heard that on the floor. I don't remember from who, but yeah, I think it's kind of a universal thing I enjoy.
Yeah. Bang on. Moving on. The characteristics of the prospect theory. Prospect theory suggests that humans tend to prefer certainties over probabilities, even if what you're going to get from the certain trade is way less than what you may get from the probabilistic trade. And that sucks, right? Because then you put a cap on what your earnings. And the more I read through this, the more it really is I'm digesting it, internalizing it. Prospect theory suggests that humans tend to prefer certainties over probabilities. Let's go with an example. For example, suppose you have a choice between being given $50 and a 50% chance of winning 100. Most people, sadly, will take the 50 in hand. You know, what was that expression? Bird in the hand is better than two in the bush?
Yeah.
Yeah, we both knew that. All right? Pardon me. Most people will take the $50 and they'll run off with that. Even though the expected value of the two options is exactly the same. When you do the mathematical calculation of it, you're going to end up with the same $50. Even if in the second scenario, you may end up with nothing. The odds say for both, you may end up with $50. Prospect theory also asserts that people underestimate or even ignore outcomes with low probability. And that's what I alluded to earlier. You look at what is the most probabilistic outcome, and you focus far less on what's less probable, even though it may be probable.
Yeah.
Consequently, they also tend to overestimate the probability of likely events, resulting in a bias that neglects improbable outcomes. This is particularly relevant to investors who must consider the possibility of unforeseen black swan events. And we talked about this on the top of the show. Black swan events, Google that. Essentially, there is an entire sector of funds, I'm not going to call them hedge funds because I don't know if they're actually hedge funds. Funds, money managers who have these black swan funds. And what they do is they basically try to prepare for a rainy day. They'll bleed money. They'll continue to bleed for years, and then comes an intervening event, a one-off event, once in a decade, once in a two-decade event, and bang, you're printing. That's the reaction I wanted.
Yeah.
That's the reaction I wanted.
I'm also very easily skittish too.
That's fine.
So I think it works even better. There we go. But yeah, no, and I think it's interesting too, if I may, just for a moment here.
Absolutely, go ahead.
There's an element to probability. It's just math. It doesn't make things more likely to happen or less likely to happen, right? So I think being aware of every possible situation and not getting too caught up in the biases or what you believe is going to happen is, I think, just very helpful. So I just wanted to put that out there.
All right. Yeah, I know. Somani beats. I mean, that's really the whole modus operandi of these funds. And that's why so few of them exist, because people don't like to watch their investment bleed for years. The Katina man says, really? No, don't you? Clearly, even though you know that there's a rational basis for that fund, because we've seen it, man. We had two in the 2000s. We had the dot-com bubble, and we had the great financial crisis. We had two. And then we got the COVID-19 pandemic in the 2010s that extended into the 20s as well. We're likely probably to see maybe another one this decade, if not maybe in the early parts of the next decade. They happen. There's nothing you can do about them. If, the 80s had them, they had them in spades in the 80s. What was that called? Black Monday? 87? Remember that? What do they call that? Black Monday or something like that? Chat will know. So that's what these black swan events are. Going on. How to overcome biases. Understanding prospect theory can help individuals overcome their biases and make more rational choices. By understanding what you're doing and how your thought process is, we can kind of delve in a little bit. For example, an investor who is aware of their bias towards high probability events can compensate by giving extra consideration to the low probability ones. If you know you're focusing on these high probability events, you can make a conscious effort to actually factor in the lower probability ones and therefore have a more complete picture. I know this is very abstract, but we're going to get to it in a second. It also helps to reframe possible outcomes in a way that reduces the impact of cognitive bias. Instead of thinking in terms of gain or loss, you can instead think in terms of the value of the expected outcomes without using the present as a reference point. This can reduce one's loss aversion bias. Now, some of the outcomes of this type of this theory. According to the great men Tversky and Kahneman, who I'm not even sure I'm pronouncing their name right, but we're going to go with that.
That's what counts.
Right?
Yeah.
The certainty effect is exhibited when people prefer certain outcomes and are underweight outcomes that are only probable. Again, this insane, it's not insane. I think it's based in reason, to be honest with you, but I think, you need to maneuver around it. For us to prefer probabilistic outcomes certainties over other probabilistic outcomes. The certainty effect leads to individuals avoiding risk when there is a prospect of a sure gain. The certainty effect leads to individuals avoiding risk when there is a prospect of a sure gain. It also contributes to individuals seeking risk when one of their options is a sure loss. Isn't that funny how that works? Another one of the effects, called the isolation effect, occurs when people have presented two options with the same outcome but different routes to that outcome. We're going to give you an example in a sec. In this case, people are likely to cancel out similar information to lighten the cognitive load. I don't blame them. I mean, the more factors you have to consider, the more overwhelmed you feel. But their conclusions will vary depending on the options that are framed. So depending on what you've excluded from your cognitive assessment there is really going to be determinative of what your result is. And that's the problem. So by choosing some things to assess and not choosing others, you're kind of giving yourself not a full picture. Here comes an example of prospect theory. This is the good one with Adara. Consider an investor who's given two pitches for the same mutual fund. All right? I come hot with one, Sean comes hot with another. The first advisor, me, presents the fund to Adara, highlighting that it has an average return of 10% for the last 3 years. Sounds good. I'll take it. Especially, when we weren't doing anything back there last year. Meanwhile, Sean comes to her, second advisor, tells Adara that the fund has above average returns over the last decade, but has been in decline for the last 3 years. Prospect theory suggests that although Adara has been pitched the exact same mutual fund she's likely to buy from me, the first investor, or advisor, pardon me, that is, Adara is more likely to buy the fund from the advisor that expresses the fund's rate of return in terms of only gains, while the second advisor presented the fund as having high returns, but also talked about its losses. What does prospect theory mean? The theory basically says that investors value gains and losses differently, despite the fact that they should be looked at equally. That is, if an investor is presented with an investment option based upon potential gains and another is presented an investment option based on potential losses, the investor will choose an investment where potential gains are presented. So we obviously know that there are probably disclosure requirements for a lot of these funds and that they have to present both sides of the coin. My suggestion to you is they'll try to, really sugar up the upside and, really kind of narrow down the downside because of a theory like this. And I think this is kind of this is something that I would have expected if I would have been asked about it.
Yeah, and it makes sense, like in sales too, it's the same thing. Like I did sales for a period of time, and yeah, you're definitely like trying to word things in like, you know, the prettiest sounding way, but at the end it's the same. You know what I mean? It's about how something is presented to you. And, you know, summing it up really well, I think I saw someone in the chat saying transparency is better, and I agree. Yeah, I think the bias tells us not to accept that.
Exactly. Last thing here, why is what I'm talking about important? Why is prospect theory important? I mean, you probably have already deduced that, but in case you haven't, here's why. It's useful for investors to understand their biases. You need to know what your biases are. Where losses tend to cause greater emotional impact than the equivalent gain. I hate that that's true, but the fact is, it is. The prospect theory helps describe how decisions are made by investors. Any questions with respect to that? I saw a whole bunch of tags that I saw from the corner of my eye while I was talking. I'm going to try to go back to them, but the first one that I see here is Big Harry Lou. I'm going to call him Big Harry Lou from now on. Sharif, no, Sharif was right. It was Monday in 1987 when the Dow dropped 22%. Funny how the memory changes to stressful events. Isn't that funny? Yeah, couldn't agree more on that. Crazy. Anything to add or say there, Adara, because I have to go through all these
yeah, of course. There's a really interesting comment here, too, from Peter Sun. Useful to understand other traders' biases, too. I think that's a really good point. I think the thing is, too, is I think being cognizant of your own biases and where you might have, like, you know, some points to learn from in some areas of growth can help you understand, A, that other people also have biases, and B, like, what those other biases might be. So, I mean, I don't want to like spoil too much of what's going to come in the rest of the week because I've been taking lots of notes and doing lots of reading. But yeah, a lot of trading psychology related strategies basically kind of purport that if you can kind of preempt what other traders will do and then react in the opposite that way you can kind of avoid hurting behavior, which I'm sure we'll bring up later this week too, but basically the idea that the whole market reacts in one way, so then that's what causes these giant crashes. So if you can kind of preempt some of these, you know, kind of ideas or what's happening, then I think, you know, I think that's very positive. Also, just shout out here too to Louis Tatora. I just wanted to shout out Sean for the snap call in general. Great long. There we go.
The Katina man. I mean, because like basically we've given you the theory, right? Now here's somebody who puts on the trades, and he's going to talk a little bit about how his trading psychology is on a day in, day out basis. You know him to be taking the trades on the open, the most volatile time of the day, and he takes big boy shares. Sean, you want to chime in a little bit here? Let us know how you feel.
Yo, what's up? Yeah, okay. Yeah, thanks, Sharif, for bringing me in here. No, look, I've just been sitting here listening, and I think that everything in practice is one thing, and then in reality is something completely different, right? I mean, we could sit here and make all these calls on stocks, but at the end of the day, we've had some ideas that have been thrown out here, and I just think that you have to practice everything that you do in sim mode first, and then actually try to treat that as much. And it's tough because, you know, trading in sim mode is not going to be reality, obviously, and your emotions are going to change. And I think that that's another sort of update to this whole talk about lower your shares and this and that. It's a completely different environment when you have real money on the line. I mean, anybody sitting here and, you know, trying to say, oh, you know, you're going to make a living day trading, you're probably not. Let's just be perfectly honest. If you have that mentality to begin with, you have to sort of check your ego at the door. You know, I think that's also very important because the stats are what they are. I can tell you stats of, you know, the floor behind us. I think we've done a good job of doing that on the show by simply telling you, even when I was hiring and trying to bring traders in, maybe 60% of the traders might eventually wind up getting, you know, in and then out of the door. Then you have your other 40% of which may be positive traders. And then I like to look at it, maybe the top 5 or 10% can actually hit a goal whereby you think it's sustainable to earn an income. So everything we're talking about psychologically has to be taken with a little bit of grain of salt because not everybody is going to be able to sit down and be able to look at your P&L, and no matter how many of the rules you follow, no matter what book you read or anything like that, it's a completely different situation, especially when, I mean, you have to look and say, and the reason why I point to the finger is that if you have a lot of commitments, you know, trading becomes much, much different. And you're going to hear me talk about this, and this is not to say there's anything different with the way Sharif, but like when I trade, and maybe this is wrong, and maybe this is why I scalp out a little bit too much, but when I see the profits floating in there, I have, for example, you know, this is going to sound silly, but like, you know, mouths to feed at home. Now, that doesn't necessarily mean that all the trading, all the money I make is derived from trading here on the show or anything like that. But the minute that you start having those, not just mental blocks, but other things that come into play as far as income and things like that, like, I don't know, like Adara and Sharif are going to be in completely different financial situations and requirements than myself, and that's the same thing for everybody here that's on the chat as well, right? Obi, who's sitting down here beside me right now, maybe just thinking of different ways of spending his money. I'm thinking about ways to spend my money, and everybody has a little bit different expectations and priorities. So I think psychological, obviously everything they're talking about is correct, but at the end of the day, you're the one hitting the keys, and you have to decide how much is too much. How much pain in the market can I withstand? What are my levels? And it all just goes back to, honestly, having a strategy that you can trade off of, that you believe in. If you put out stop orders, if you have proper risk management, things like that, then the mental will sort of come. Because all of a sudden now you can sit back and relax a little bit because you know your strategy is in place and you kind of let it run. You know, it's kind of like once you have a successful business and you've hired the right people, you can just trust that the business will run successfully. Now, do you have to have proper stops in place? Of course, you know, and that's true for all of your businesses. But at the end of the day, no matter what you got going on up here, you know, you have to let the trading do most of the talking for you. So I just think that turning off the P&L can be helpful as well. If you keep on looking at your P&L, I think that's something that you might want to, and again, thank you. I know, write a book, yada, yada, yada. So if someone has ChatGPT, please just copy everything I'm saying, put it in there, and then get going. But no, it's true. And I'm just saying, like when I used to hire, and I, again, point to the ring, I didn't like hiring people, traders, that had responsibilities, I guess, right? Rather
very interesting.
Kids. Because if all of a sudden you're saying, hey, I got to trade to feed my family, I feel like you're already starting behind the 8 ball, right? And a lot of us are probably in that situation. And that's a tough one to be in, for sure. So I think psychological, you sort of have to get through all of that. You need to be trading for the right reasons. And I think that if you're starting trading and you're looking for an income, that's going to be the wrong place. You have to love what you do. You have to be patient. You have to be responsible. And if you're all of that, then trading psychology should eventually fall into place. But it is a super, super important aspect of trading. But you have to have confidence and understand who you are before you step into the ring with a bunch of animals.
Thank you very much for that, Sean.
You want to ask me anything, Sharif?
There was a question for you.
Yeah, there was plenty of questions in the chat.
Yeah, here's one from Elon. Hi, Sharif and Adara. Can you please ask Sean to share with us his psychology on how oftentimes he takes a counter trend trade? Cheers.
Okay, so
I think you're more with the
right
trend.
now I'm long Apple. Like, so for example, it just goes back, and great question, sort of. It just goes back to having. Oh, Obi.
What did Obi say?
No, because I said sort of. I just said great question, sort of. No, the reason why I say that honestly is just I'm looking for a stop right here on Apple, by the way. 188.40 maybe. Okay, the reason. What happened to me?
You're coming. They're just fixing it. There we go. There we go.
By the way, nice color of shirt, Adara. I like it.
Oh, yeah, we're matching.
Very, very
I love it.
Brenda was going to wear salmon today, too. It would have been the 3 of you guys. It would have been very interesting.
Actually?
Yeah, he was.
Oh, that's crazy. Oh, my gosh.
That would have been the best clothing day in Trader TV Live history. But okay, so I'm just getting some more shares here. All right, so the idea for that question is, and I think that I have Obi, Mr. Counter Trend, right beside me. The thing about that is it just goes back to that first example that I said. It's trading strategy. You know, like if levels are hitting and it means that you go long and the trend is short like it is today. I mean, right now you're above the 50 period, you're above VWAP. So for me, I'm looking long. You know, is it going to be counter trend maybe on a 20-minute chart or something? Sure, fine, but you have to stay within your own sort of strategy, and then that goes to trading psychology, right? Because if I just take a trade based on the technicals, then really the technicals should also get me out. You know, so that's something that I could do that. Amen, Sean. Yeah, preach on as I continue to do here. What else do you guys want to talk about here? All right, I'll read this one. Parabolic, because he said amen. I spent at least 6 months paper trading before risking a dime. Yeah. I mean, that's what it is. It's about just learning your rules. And I think that, you know, it wasn't a hugely successful month for the office behind me, but I stuck to my rules and was able to stay, you know, net positive. And I think sometimes I can actually, even me, after being, you know, after being in bad trades, I kind of get that feeling, and you guys can see it if you watch me trade, where I'm like, oh no, this is not right. Like, why am I shorting this? Yet I go more short, and then eventually it blows you out, and this was happening to me for a while there, and I just stopped doing that. You know, like once you get that feeling in the pit of your stomach, like this is not right, then you kind of got to back away a little bit, right? Which is part of the game as well. So, all right, did you guys say anything else there? What's up, Adam to lose? What's up to don't? Shoot me. Adam is? What up, Adam?
Numero uno Arsenal fan in the chat.
All right. Well, that's good. I mean,
but thank you for that, Sean.
Yeah,
that was very.
I'm not going anywhere. If you do want to fire off any other questions.
And I just
think it's a good question there from Luis there. The common theme is understand yourself.
Bang.
And I think that was self-awareness. That is great. And Shreve, it's like, you know, when you're trading futures or Adair is just getting started right now, you have to find stocks that you're comfortable with, and you have to find strategy that you're comfortable with. We have some traders right here, right now, that only trade futures, that only trade, for some reason, rebate strategies and things like that. So you have to find your own happiness and the levels that you think. And then at the end of the day, guys, again, I could go on and on and on. I apologize for how long this is taking. You guys brought it on yourself. I mean,
no, man. You're giving good information.
No, I love the insight.
So the other thing, the other part about it is, and now I sort of forgot what I was going to say. Oh, was just build your own spot, build your own niche, right, and figure it out. Because at the end of the day, this market is something where you're battling like. What are they hiring on Wall Street right now? They're hiring like
quants,
mathematicians, quants, this and that. So now all of a sudden I'm sitting here with my poor old hands trying to fight this market, right? Well, meanwhile, there's other things in the back end that are just continuously to build against me, right? Exactly. Everyone's fighting against you. This is you're getting into the ring where when you go long, someone else is pushing the short, you know? So you have to have sort of self-confidence that you're going to be right. And don't be afraid to lose it all. You know, because you're going to make bad decisions at some point. And by losing it all, I don't mean your whole account, but maybe you've made $300 on the day, you see a great setup, it's setting up, and then you just take the trade. Sometimes it doesn't work out in your favor, but build the positions whereby you are most comfortable. So anyways, all right, I'll give it back to you guys, Sean. And that's enough for me.
Thank you so much. I really appreciate the insight. And I think especially as someone who's still learning, I think it's really invaluable stuff for me to hear.
Unquestionably, too. I mean, because he does it day in and day out at really volatile times. And one thing he didn't mention there, and I don't want to put words in his mouth, but when he was talking about staying in his own lane, you know, you guys notice that he trades like 99% of the time. It's going to be the Mag 7. It's going to be the large cap stocks, the mega cap stocks. That's his wheelhouse, right? He sticks to that. You know, nary does he take a trade that, you know, like Minim. I think Minim is the only time I saw him, you know, maybe in the last like maybe 4 or 5 months that he took a small cap. And there's a reason for that. But that, oh yeah, that's him. Okay, he traded GME. He wanted me to mention GME. Yeah, he did. And it's still the exception, not the rule though. But shout out to Sean. Lots of good feedback in the chat, guys. Thank you for putting in your feedback. More questions. If you've got more questions for Adair and I, or even others, put them in the chat. We'll try to get them answered. Sally Huang, how did you start your trading journey? It was really simple. It was during the lockdown when all the offices were shut. I had to close my own office as well. Stayed at home, had a computer. was always interested in financial markets, and I'm like, hey, why not, right? Started looking at small caps. I started my trading journey with small caps, the small cap gappers that I call crappers, that come in on an intraday or on a daily basis, new trades every day. We're gonna get in a future segment about how to find stocks to trade. We'll be talking about that. But typically you find them on a scanner to see what's up, double digits, triple digits on any one day. Usually they are lower flow, small cap, one-hit wonders, sort of, if for lack of a better term. And that's how I started. And then you get into that, you start turning on CNBC, you find these guys. That's how I found these guys. December 2020 is when I started watching this show. It'll be almost 4 years soon, next year, obviously, that I've been either participating in the show or a viewer of the show. And that's how I kind of made my way out of small caps into some of the mid caps, some of the large cap stocks. My journey may be atypical than other people's, but I think a lot of people found trading, intraday trading, even swing trading during the pandemic because they just got locked down. They didn't have anything to do, right? Can't go out, can't do this, can't do that. So that was my foray into it.
Great word, foray.
Yeah, thanks. Let's see here. Don't shoot something. Curious what your best advice tip for someone struggling to sell a winning long-term swing position that's over 100%. So some people have rules that if it gets over a certain percentage or if it becomes larger than a certain percentage of your account, they automatically trim. That's one way to look at it. You can have rules that are employed like that. The other way to do it is to get out on a technical basis. So what you're looking for, you hear me talking about it ad nauseum, is the making of a lower low, right? If I see a lower low come into play, to me, at least, the trade becomes invalid. I do really rely heavily on higher highs and higher lows. I like trend trading, like the continuation of the trend. So a newer low, a technical level, would be a great reason to get out. You're gonna have to do a lot of charting, whether on a larger time frame, a narrower time frame. Looks like you're holding a swing, so I'd be either trading on the 4 hour or the daily on that. So look for key technical levels that are being breached. Or if you want, just take a piece out. This is kind of a subjective way to do it. You take 25% out, you wet your beak on some profits, right? But just what I would suggest is try to have the exit founded in reason, founded in logic, not based on emotion. I'm up 100%, let me get out because I'm excited and I want to lock in some profits. Stick with the system. Whether it's, you're trimming because it's too heavily, it's up too much, or it's too much of your portfolio, or it's breaching a key technical level, whatever the reason is, just make sure that you stick to it and it's found in reason, Adair.
Yeah, and I think too, like wherever you want to set your beak wetters, as Sharif often says, like kind of set them in advance and then kind of, maybe try to adhere to that or decide, how much do you want to piece out at a time. Like even an example kind of for that is, I'll talk about this NVIDIA short I'm in right now. I got in teeny little tiny, like literally the smallest amount of shares I could take here. I got in just because I did like the, the kind of downward momentum here, but NVIDIA is a riskier stock. I'm in another short as well. Which I guess I can touch on in a bit. But yeah, so basically, kind of like factoring in all of these risk elements ahead of time, right? So then if you do take profits, you kind of know where you want to get out. Like, so for example, it is a bit of a smaller risk because I did take smaller shares in the first place. So yeah, if we get to like 450, 450, I might, get out here, right? Because it's like, just kind of deciding how much you want to get out of a trade. I had like, pretty successful NVIDIA long earlier, ended up being a $2 paper trade winner. With half of my shares. So yeah, no complaints there, just kind of trying, I guess, yeah, and the point I'm trying to make here is to kind of, if you have a plan ahead of time, then I think it's less easy to get lost in the sauce and, the whole fear versus greed thing, right? I think it can be really easy to succumb to greed if you're in a winning trade and you don't know where to like push, the out button and let the elevator trap door kind of fall with you, right? So I think being very cognizant I think of what is going on in the market and what you want ahead of time can help you kind of stick to those wins. Like, so for example, in the NVIDIA long earlier, got in at 454 and I knew I wanted to get out half my position at this 455. It was VWAP, which is definitely an area of contention for NVIDIA today, because we were saying, you know, not all indicators are going to interact with everything at all times. But I think in this case, this was like a fair, you know, place to get some of my NVIDIA out. So I did get out half there. Then I decided I wanted to go at 456 because I was like, you know, let's use like another whole number here. I got in at 454. I got half out at 455. So I was like, let's stick with the whole, you know, the whole number thing. So yeah, I did get out the rest at 456. I could have stayed in longer. I could have had an extra $1, but that wouldn't have been adhering to the plan, right? So even though this is, like I said, I'm still in the simulator, it's not real money, but you know, I still want to make sure that I'm adhering to a trading plan. So, you know, if I do, you know, trade real money, that I'm still, you know, adhering to, I guess, the values that I'm trying to learn here as I'm still learning. And I think, you know, there were some conversations in the chat, I kind of consistently, but I know last week as well, about the idea that, you know, paper trading is, you don't really learn as much sometimes because, you know, you're not using real money, so it can be easier to make riskier decisions. And I agree, and I think basically what I'm kind of trying to tell myself is I'm trying to act like, you know, it's still just as important, because I want to make sure that I'm developing habits that are going to be useful should I be trading for real. So I think, yeah, I think it's like learning how you want to actually, I'm trying to find a way to word this, but basically like learning in a way that's going to be productive longer term instead of just learning lessons you're going to continuously forget. I guess that is my approach to that in kind of a longer term, more roundabout way. But yeah, I mean, having plans in advance and kind of, you know, thinking about what you're learning, how you're learning, and then knowing when to cut losses, I think that's all kind of part as well of kind of what we're talking about here, right? So I think that is kind of an interesting aspect. And I know paper trading is not the same, but I think, like, you know, trying to kind of adhere some of these mental, or apply some of these mental aspects and adhere to them in this form to hopefully help should I go live? There we go.
You know that Renata stole my money?
I know, I saw this whole back and forth.
She's like donating it to other people.
What, she's donating it to other people? Robinhood, okay.
And it's because of Bears versus Bulls. I love him, right? But he's like, hit accept. And I'm sitting there in the middle of like a full-out discussion, and I don't know what's going on. I'm like, okay, I'll hit accept. Maybe somebody sent me money, and Rihanna stole 1,000 of my points.
I can see that.
All right, I'm gonna remember that.
Yeah, she was pretty gleeful.
I'm gonna remember. Yeah, she's so proud of herself. It's like, oh, I'm so good. All right. Okay, I see you. No, Bears, I mean, come on, take that back. Thank you for that, though. You sent me another 500 points. I appreciate you, man. No, send that back. Look at her. She's distributing it to other people. Who wants points, she asks. It's my money. No, I'm kidding. All right, let's get to some questions, guys. Yeah. Big Wick Energy. That is a fantastic handle. I love it. That's hilarious, dude. Oh, my God. Can you soak to having, what? Can you soak to having and getting past bear market PTSD? I'm still procrastinating on my trade because of past traumas and bearish counter thoughts. Really good question. I'm trying to think of how I handled that when I took big L's. Be honest with you, multiple L's in the personal account, to be quite honest with you. Look, you just gotta, yeah, it's a really good question. Personally, I try to base it on objective criteria. Like, look, why am I getting into this trade, right? Is it a long-term trade or is it a technical trade? First things first, right? If it's a fundamental trade or a technical trade. If it's a fundamental trade, I'm basically relying entirely on the fundamentals. And if the fundamentals change, then my opinion will change. If I'm getting in on the technicals, then I know that I have an entry, a profit taker, and an exit. If it triggers my exit, like I did with UNG, and breaks that level, I'm out. So you're going to have to trust the process. It sounds super cliche, but if you don't get into the trade, you're not gonna make any money. Just make sure that you understand why you're getting in and what basis is going to force you out. If it's a fundamental reason to get you out, like earnings come out bad, or deliveries, in the case of an EV company, come bad. I'm just giving you an example.
That's a really good example.
Right? Deliveries come bad, then you have a reason, a logical, rational reason to get out. If it's a technical trade, you should already know where your out is going to be, and you suffer the L. And hopefully, over the course of multiple trades, you're able to make some money if you use the risk to reward ratio that we talked about in week 1 when we first started talking about managing risk. And that was our first week discussion. And the reason we want to start with that is because I think it's the most important, especially if you're intraday trading or day trading, okay? You can get blown out real quick. And again, I used the example at the time of this anecdote that all of us day traders hear, that you have to blow up multiple accounts in order to really understand the value, not the value of money, but, understand the nuances of day trading and to actually understand the feelings of losing money and how to kind of acclimate to that and adjust to that. I don't think you necessarily need to go through all that if you just follow the rules and you know why the rules are there in the first place. If that makes sense to you, then you don't need to suffer the emotional pain that comes from blowing up multiple accounts. Yeah. I don't think that that is a requirement, but that was just my experience. I haven't blown up multiple accounts. I haven't. As Daniil says, nobody ever went broke taking profits, says Tony Price, and you're absolutely right on that. And Neil does say that all the time. Yeah, he does. He says it all the time. Moving down here, just looking for some questions here. I
think one thing too, if I may, like off of what you were just saying too, I think what a huge thing I learned from Risk Management Week from you that I kind of still try to apply that you just kind of mentioned here was whatever is going to get you into the trade, help that propel you out of the trade. So it's like if you're getting in based on your technical levels, if you're in a long and you see a lower low, bye-bye, adios, sayonara, get out, right? So I think like kind of having that framework in mind has really helped me with my entrance and exit strategies. And I think it's actually helped me help with the emotional aspects of trading and the psychological aspects, because now I know I don't have to worry arbitrarily about getting out of a trade. I know I'm getting out if X or Y occurs.
Exactly.
Right? So I legitimately think that has been really helpful.
None of you bits says cry for umpteen amount of days and then get back on the horse. Man, if that works for you, if you need to cry up a storm to get it out of your system, cry up a storm. Who's in the room with you? You know what I mean? Well, unless you're going to share it in the chat, we're not going to know. I mean, I'm just, I'm being glib, but I'm whatever really works for you, for your specific psychology, for your specific, based upon your experiences, fine. As long as it's effective.
Because no two people are going to trade the same,
Futuristic says, bang, on Carvana short. We haven't looked at Vana in a little bit of time because we've been talking up a storm, but let's have a look here at Vana on an intraday basis. It's been a looker today, 42 reject, bit of multiple touches in and around that 42, and then you have a nice move down on Vana at the moment. Let me switch up Uber here, put CVNA.
I guess it's running out of gas a little bit over here.
Oh, you were waiting for that, weren't you?
I really was.
You were waiting for that 15.25% on Vana. It's trying to hold 40. It's above VWAP at the moment, so it's not a bad look on Carvana. Volume dropping off a little bit though. Let's see how it does at that 40 level. Looks really interesting. If it comes into 40, it's a whole dollar level, and it's VWAP. You look for confluence between two different indicators. Shout out to the Kenobi. Yeah, he's over there. He's over. Yeah, confluence, he says. Confluence.
Also, Futuristic, I think, says they went short at 41.78. So
Wicked.
That's a pretty good look, yeah.
Oh, yeah. That's
fantastic.
Over $1 winner right now for you, my friend.
Congratulations. That's beautiful.
Man of the People Media, Sharif, does a firm look like a double top or an inverse head and shoulders on the 5-minute? Let's have a look. AFRM, it's been an absolute rocket as of late. A double top, on the 5-minute, no question about that. And then you can see it absolutely tank there. Oh, not tank, sorry, that my chart was wrong. Yeah, guys, for some reason, if I don't have the watch list up on the side, the chart ends up being a little bit delayed, but there you go. AFRM, put in that ticker. Obvious resistance at 39. Look at how all the wicks come into 39. All of them are rejected. All the closing prints south of 39. I would say, look, wait for a VWAP. Look at what it does at VWAP. Does it break that 38 and a third, or does it find some support around there? We talked about double tops and where to get in and where to place your stops. In this case, a little bit extended, because technically the rule on VWAP is you need to be getting in through the break of the V, and your stop has to be at the top of the double top. In this case, there's just not enough room on the intraday basis for that to be the case.
It seems pretty tight.
It is. It's way too tight. So you're going to have to either not use that technical pattern to get in on this name because I think it just gives way too much in terms of risk and not enough of a reward. Even when you measure down to the possible low of day around 36.70, your entry would have to be at 37.50 or even below that. It's just not enough risk to reward ratio there. So you're going to have to forego that trade if you're going to use those rules, by the way. Blackberry, Adair, Sharif, I think real trading and sim should complement. I only use real money and lost 85% on learning the last 2 years. In retrospect, not good. I'll do the sim for now. And like one thing that I was told when I first started trading is if you can't prove profitability in the sim, you have no business using real money. Because your strategy doesn't work in the sim, it's not going to work in real life. It's only going to get harder because then you have to include the psychological stuff that we're talking about today. And you're going to find your job even more difficult, more of an uphill battle at that time. Prove profitability in the sim before you ever use real money on the line. Take that. If you want to take that piece of advice, go for it. If not, Tim is in. Cry with Jesus. That's what I do. All right, Tim. Sounds good. Hampton Trader. I cry too. Take a few days off, then back to the market. Shout out to you, Hampton's Trader. Whatever works for you. I'm not here to judge anybody for any of their dispositions or what they do.
Each strategy is going to work for each person.
Yeah, and we accept you as who you are. Fry Rye.
Yeah, welcome to the community.
Absolutely. I'm not here to judge. Fry Rye. Hey, Sharif. Do you think indicators help our psychology when it comes to selling things, or can it hurt our way of thinking? Like any one indicator, you never want to put too much weight and too much stock into one thing alone. Look for confluence. You're looking for multiple things to point you in the same direction, whether it's multiple time frames that you're looking at that conflate, or whether you're looking for other indicators that conflate with the price action, what have you. Look for multiple reasons, okay? And then when you do that, it really shouldn't be about only using indicators when selling. Indicators need to influence your entire view of the trade, whether it's your entry, whether you're staying in the position. I'm not just talking about indicators, I'm talking about the data you get from the trading program, whatever it is, whatever you're using. It needs to influence your decision on both levels, your entry, whether you stay in the trade, and whether you exit. Don't use some just for this and some other data just for that. It's got to influence the full picture. That would be my answer to that. The boring man, Sharif. After taking losses, I started walking 10 miles a day for about 5 to 6 months to get back in trading. Walking helps to relieve stress. I couldn't agree more. I couldn't agree more with that. You clear your head. You make objective assessments of your performance and of your trades. You kind of get away from the desk over here and all the information that's coming in, the information overload that often traders experience. You get away from it all and you help clear your head. It may work for you. It may not work for Adara. It may work for Obi. May not work for Sean. Whatever works for you. As nuanced as our psychology is, you have to assume that our coping mechanisms are going to be equally as nuanced, okay? So that's what I would say to you on that.
Yeah, I think it's interesting too, if I may. I think how we cope usually is a reflection of our personality. So if there's like a certain, like for example, like I play piano, so sometimes when I'm coping, like I'll just kind of play the piano a little bit, right? Obviously that's not going to be a coping strategy that works for everyone.
Right.
Like, or some people like coping strategies like working out in the gym. If you don't like working out, that's not really going to work for you, right? So I think just as each of our personalities is going to be unique and each of our trading styles will be unique, I also think that whatever you use to cope with like trading and just in general is going to reflect you specifically. So don't I guess feel like you have to adhere to a certain type of trading or a certain type of coping mechanism. You do you, as cliched as that may sound. Also, the other thing too I want to mention that Ramin in the chat, I sleep.
Yes, Ram.
I love
I
just
told
like the
Breno
mic
this
drop
morning,
moments.
like she came in, I joke around with Ramin a lot, but there is a cutoff point that there's a certain time of day where no jokes go Ramin's way. You have to allow her, you have to allot time in the morning for her to wake up, for her to become receptive to the jokes. Otherwise, you kind of just get a glance. You don't be joking with me right now. I'm not ready yet, right? Shout out to Ram. We're just busting chops. But she wears her glasses inside for whatever reason. We're not really sure why at this point quite yet, despite asking several times. She comes in.
You're acting like this is like an anthropology thing.
Yeah. She comes in. The lights are off, right? The lights are not on like the way they are right now in the morning, yet her sunglasses are on. And anybody who knows anything about Toronto, at 7:30 in the morning, it's dark. Why are the sunglasses on, Ramin? That's what we want to know. Obi, this is why Obi is wiser than us all.
Obi has like the great one-liners too.
Absolutely. He's like, sometimes stunting is a habit, and she's stunning. She's stunning on everybody. I
really enjoyed that.
Shout out to the Kenobi for that one.
That was fantastic.
Honest Abe 90 asks a question here, Adair. Do you think when you are starting, you should have multiple sources of income? Yes. Sean made this point very clear. Anecdotally, I've heard similar things. The people that need to make money from trading end up losing money. And it's those who aren't reliant on the money, who allow themselves, not to be overcome by the fear because, you need this money to pay a bill. You need this money to put food on the table. When you end up putting that kind of pressure on yourselves, things don't really work out as well as you'd hope. That's anecdotal. I don't have the data to support it. But I would say to you, yes, you need to have an alternative source of income because, quite frankly, unless you're gifted, and I've said this multiple times before, very gifted, you are likely to be losing money the first, little bit. Now, little bit can be subjective. It can be months for some people and years for others, okay? Yep. Moving down the chat. Fry Rye. I was using MACD and the 8 EMA and the 21 MA, 8 MA and the 21 MA, pardon me, to get into a short on AMD. Do you think it's the right call if you go over the chart? I was using the 15 MA and the 5-minute look to get a reverse at 119. Well, I don't use any of those moving averages. As you know, I use the exponential moving average, and it's the 50 and the 200 that I'm interested in the most. But I'm going to have a look at AMD.
Yeah.
Thank you.
Call it by its proper name.
I know, get it together, Sharif. But I do, look, aside from any of the moving averages that you're using, that 119 hold looks great. It comes up right into 119, and you could see it start to curl back down. Now, we have to figure out, is 119 an important level? Well, kind of. It's not an exact level, but look at what we did here. And this is Friday's low. Look, forget about the wicks. Look at the closing prints. They're all 10 pennies off that 119. Surprise, surprise. Former support acting as resistance. Where have we heard that before? Oh yeah, everywhere. No, literally. They always switch roles. So I like that. I like this trade for that reason. Not because you're using moving averages to get in. Especially, I don't use the 8 and the 21. And I don't use them especially those short of moving averages on the large caps. Where I tend to use shorter term moving averages, exponential moving averages is on small cap gappers, not on these ones. But I like this trade. Support on Friday looks like resistance on Monday today.
Yeah. There's just a question here I really like from Tobias Hernandez that I think ties back to what we're talking about pretty well. Thoughts on the difference between being married to a stock versus just knowing your stock well? I think it's a great question, and I honestly, I don't have, a ton of experience with it, right? But I would venture to say that I think the difference is if you know your stock well, it's just kind of more like knowing, I guess, what the appropriate entrances and exits are. And I think for myself, at least, I'm in Eli Lilly right now. This is a stock that I pay attention to a lot, but I'm not going to jump in it unless I actually see a point of interest, right? So I got in here because we had this big movement up. We kind of had a double top, and then we had a nice little pullback. So I got in on the pullback, and we're like, a little over 50 cents in the money on this, right? Or paper trade cents. But so basically, I think I guess what I'm trying to say here is you know, you could have stocks you like and you pay attention to them because you like them and you're kind of familiar with how they move. Where I think it's more being married to a stock is when you're looking for excuses to enter the trade or trade that stock despite an actual lack of places to enter, right? Like if you're just entering because you really want to be in this move, or if you like a stock, you miss the movement and then you try to counteract that by getting in a little late, that would be my take on that. But I think it's a very interesting question, and I think everyone will kind of have to, you know, come to their own conclusion on that. But yeah, I think it's a good question. Hopefully that answers it a little bit for you.
Can we, should we go through the material one more time?
Yeah, let's rewind.
All right, you're up this time.
Absolutely. Okay. So what is the prospect theory? So basically it is a theory, surprise. But yeah, it assumes that losses and gains are valued differently. And that individuals make decisions based on perceived gains instead of perceived losses. So it's known also as loss aversion theory. And so the general idea is that if you have two choices, and they're both equal, but one is presented in terms of potential gains and the other one is presented in terms of potential losses, then the former option will be chosen even though literally they are exactly the same. So how does this work? So basically it's part of the behavioral economics subgroup, which is just a whole fancy part of economics and I guess behavioral science that kind of looks at how, and this specific theory kind of describes how individuals will make choices between probabilistic alternatives where risk is involved and the probability for different outcomes is unknown. Probability, a big word that's going to keep coming up here. But yeah, so the theory was formulated in 1979 and then further developed by Amos Tversky and Daniel Kahneman. I apologize to both of these gentlemen for maybe pronouncing their names wrong. But yeah, so basically it's deemed more psychologically accurate because it actually looks at how decisions are made compared to the utility or the expected utility theory. So the underlying explanation for an individual's behavior under prospect theory is that because the choices are independent and singular, the probability of a gain or a loss is reasonably assumed as being 50-50 instead of the probability that is actually presented. So essentially the probability of the gain is perceived as greater, even though, again, it's really not. So Tversky and Kahneman proposed that losses cause a greater emotional impact on an individual than an equivalent amount of gains. So basically, we weigh losses more heavily in our minds than we do gains. And maybe that comes from masochism. Maybe that just comes, you know, like from we're generally risk averse as people. But if we see a bit of an L, we're going to take that a lot harder than the thrill we feel when we have a win. Unfortunately. But yeah, so essentially, yeah, the probability of gain is perceived as greater even though it really isn't. So for example, assume that, like, let's say I'm going to give Sharif $25. And one way of doing this is I just give him the 25 outright. And the other way is I say to Sharif, hey, here's $50, but I'm going to need 25 back. Either way, Sharif is getting $25.
Oh, yeah.
But he may perceive, but he may perceive it as a loss the second way, even though he has still gained $25. He just had to get 50 and give 25 back first. Is it convoluted? Yes. But is it a loss? No, it is not, right? So basically, people will kind of view the idea of a singular gain as more valuable or more favorable than a loss, even though, again, it's not even really a loss and it's the same amount regardless. So there are two phases of prospect theory, actually, the editing phase and the evaluation phase. It kind of is like if you write a paper, I guess.
Honestly,
because you have to edit it and then you have to hand it in to be evaluated.
Yeah.
But yeah, so basically, the editing phase is when people actually decide, and these are all cognitive, by the way, too. They kind of happen without us even being aware.
Right.
And so the editing phase is where you actually decide what information you're going to use in the evaluation stage. So it's the use of mental shortcuts to assess what information is important and what options are available. And they also decide what outcomes are most desirable, even ranking the priorities in your head. So it's really cool to think about like what we're doing and not even realizing it. But yeah, for now, we're going to have a short little interlude here.
All right, guys, we are brought to you by Benzinga Pro. Use the link in the description for Benzinga's greatest deal of the year, including 75% off Benzinga Pro. Monthly subscriptions now as low as $49.25. The everything terminal for retail traders, baby. Visit pro.benzinga.com and use the coupon code TTVNOV. That's TTVNOV to save 75% off now. New subscribers only, and conditions do apply. And one thing I can tell you is that Adara is very adept at using Benzinga. It's her go-to source. Can we bring that bad boy down?
I was going to say, it'll take me 2 seconds to pull it up because it's always here.
Welcome to Benzinga Pro.
AMC, what's going on with the AMC?
Everything there, Adara. You got the scanner, you got the research, you got the news.
Charts.
everything, the watch list, the calendar, movers, you have it. It's all there.
I always have it up because you never know when you will need it.
There you go.
Which is all the time.
Sorry, didn't mean to interrupt you there, but we had to get some housekeeping out of the way there.
Yeah. Sorry, my whole setup just got.
All good.
My setup
here. You know what it is? You probably shook the thing.
I probably did.
Shake it again, and it'll all come back. No, so you gotta grab a window and then shake it.
Okay.
Okay, and then do it again. No, let go of it. There you go. And now grab it again. Shake it more violently. There you go.
Oh, there. Okay. Yeah. Well, yeah, we're partially back up.
You want me to take over while you get?
Yeah, if you don't mind.
Sure. Where'd you leave off?
So much. I was on the evaluation phase.
Evaluation phase. Okay. Did you get to the evaluation? All right. Evaluation. So we talked about the editing phase. Now we're going to talk about the evaluation phase. The editing phase is the data set that we're going to help use in the decision-making process. Hence, evaluation phase. This is the stage where people make their final decisions based on the assessments, you guessed it, made in the editing phase. People weigh the probability of each outcome and take actions based on the perceived likelihood and the desirability of each outcome. I mean, this is one of those things where it just makes me think, the desirability, how often does your desire for something to run or to continue to move up in the case of a long affect your decision to stay in the stock, right? We've always heard about this. Yeah. Cutting your winners early and holding your losers for way too long. This part probably has a lot to do with it. One of the worst tendencies for traders to cut their winners too early and hold on to their losers for too long because of the desire for it to run. It is important to note that these decisions are not necessarily based on rational calculations. Prospect theory posits that people tend to be risk averse when the stakes are high and risk accepting when the stakes are low. Obviously, we can see why that would be the case, but there is no reason for that to be the case because the math doesn't suggest that it's going to be one way or another. We know why people do it because they don't want to take big L's when there are, there's a lot at stake, but they're not willing. They're more willing to take the L when there's not that much at stake. In other words, they tend to make choices that minimize losses. They tend to make choices that minimize losses rather than maximize expected gains. Think about that.
Yeah, it's deep and it's very masochistic of us. Yeah,
it is. Oh, I like how you threw that in there. Eh?
I just like that word. Okay. I really like that word.
I used to personal train when I was in university. I used to be known as the masochist.
That's quite the reputation to have as a personal trainer.
Or you thought? Are you? Oh, okay. Everything good? Everything's always good, the Katina man says. He said, ay, 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 so I had to inquire. Did you?
Oh, that's so funny.
Yeah, I used to be known as the masochist because I felt no pity for my clients.
Oh, yeah, you were like...
I didn't care.
Wait, isn't that sadism then?
Sadomasochist.
Oh,
right?
Okay. Oh, so it was like all of the above.
Yeah, I know, right?
That's an intense reputation to have.
Really put them through the ringer, but for their own good.
Yeah, I mean, and I think too.
Like they came to me to lose weight, Derek.
Yeah, and if you're signing on for a personal trainer, like you want to work, right?
Yeah,
but no, I think that's a cool perspective. But yeah, so it basically, I think it comes from a little bit of a skosh of sadism.
Skosh.
Or masochism, sorry, in us. As we're not willing, or we're too willing to accept the sadism of the market, to bring sadism back into it. But yeah, so what are some of the characteristics of prospect theory? Also, thank you for giving me the time to get my reset up there. But yeah, so some characteristics. So basically, prospect theory suggests that humans tend to prefer certainties over probabilities, even though nothing is certain, right? That's the funny thing, is everything is kind of a probability. It's all like fancy little statistics. Who knows? But yeah, so for example, suppose that you have a choice between being given $50 and a 50% chance of winning $100. So now earlier today, I was like, oh yeah, give me the $50, right? Sharif was like, well, think about that for a second. And it's a good point. And I think I was really emblematic of this theory, even just by saying that. Oh.
You can't just drop that in and expect like I'm not going to hit the word of the day button.
So I
emblematic, I like it.
I just like the words.
Go ahead.
But yeah, so basically, even though I would say I'd take the 50, literally it would not make a difference if I took the other option. It just sounds fancier when you're saying you're getting 50 out front instead of a 50% chance of winning $100. So the expected value is exactly the same. So prospect theory also asserts that people underestimate or ignore outcomes with a low probability. So they'll also overestimate, the probability of likely events. So basically this results in a bias that neglects improbable outcomes, even though improbable outcomes can be real. That's the whole basis of the black swan theory, which is very interesting and something I would like to learn a little bit more about for myself. But yeah, how do you overcome bias in the market? I mean, very difficult. With a lot of difficulty, it'll take time. Especially something like loss aversion, which does come from this understandable psychological need to protect ourselves from losses. But yeah, so understanding prospect theory can actually help to overcome these biases and make more rational choices. So an investor who's aware of their bias towards high probability events can compensate by giving extra consideration to low probability events. So it also helps to reframe possible outcomes in a way that reduces the impact of cognitive biases. So instead of thinking of gain or loss, you can instead think about the value of the expected outcomes without using the present as a reference point. And this can actually potentially reduce loss aversion bias. But I'm sure everyone will have their own, approach to reducing these biases because everyone's trading strategy and risk strategy, psychology, trading personality will be a little bit different. So what are some of the outcomes? So basically, according to Tversky and Kahneman, the certainty effect is exhibited when people prefer certain outcomes and underrate outcomes that are only probable, even though, like we said, kind of all equally possible because the world is crazy. But yes, the certainty effect can lead to individuals avoiding risk when there is a possibility of a sure gain, or when there's a prospect of a sure gain. So it contributes to individuals seeking risk when one of their options is a sure loss. So basically, it's another example of us being hard on ourselves and being a skosh masochistic. And the isolation effect occurs when people have presented two options with the same outcome, but different routes to the outcome. And so in this case, people are likely to cancel out similar information to lighten the cognitive load, and their conclusion will vary depending on how the options are framed. Here's an example of prospect theory, and we're going to switch it up. We're going to go Shark Tank on this last one here. So let's say I don't know, let's say for some reason the sharks are pitching me. So Kevin O'Leary is like, oh, hey, here's this mutual fund. It has an average return of 10% for the last 3 years. But meanwhile, my queen, Miss Barbara Corcoran, is coming up and is like, here's the same fund, and it's had above average returns over the last decade, so like 10 plus years, but it's been in decline over the last 3 years. So meanwhile, Barbara and Kevin are basically pitching me the exact same theory, but most people are more willing to take the Kevin O'Leary theory or the one that he's proposed, his mutual fund, because he's basically emphasized the gains, whereas Barbara has presented a wider overall picture.
Damn it, Barbara.
I love Barbara Corcoran. But yeah, so I know that's an unpopular opinion, but yeah. So basically that's kind of an example there in the wild, just using, Shark Tank names because why not?
I like that. Yeah.
But yeah, so that's kind of the wider picture with more honesty, with more transparency, as someone in the chat said earlier, it's actually the better option for the investing because it's giving you a better chance. And again, like literally it's the same fund. It's about how you word it. It's about how you spin it. And so, yeah, so even though they are the same, the chances are I'd be more likely to take Kevin O'Leary's, the fund that Kevin O'Leary has presented, even though, again, same fund, same likely outcomes. So what does this actually all mean, all of these like little fancy terms we've been throwing around all morning and afternoon? So basically it says that investors value gains and losses differently. So if an investor is presented with an investment opportunity based on potential gains and another based on potential losses, the investor is going to choose the investment where the gains are presented, even though, again, likelihood is the same. And why is this important? Well, it's useful for investors to understand biases and to be more cognizant of what is going on in their brains while they're making these decisions through the editing and the evaluation process, which they're not even aware of. And the prospect theory helps, I guess, describe and understand how decisions are made by investors. And before I pass it back, there was something that Bears vs. Bulls said that was really funny, and I can't lie. The Masochist and the Punisher live on Trader TV. That's what it was. So shout out to Bears vs. Bulls. Great moderator and very funny as well.
Fryer had really good questions, and him and I were going back and forth in the chat while they was explaining that part. And he had great questions. So it was with respect to profit taking. His initial question was, how do you personally make the decision to hold on to something instead of cutting your winners short? And my answer to that was quite simple there. It has to be based, your reason to get out needs to be based on objective criteria. Whether it's a profit target or a stop loss, it must be objective and predetermined. And that we all talked about when we talked about making a trading plan in the first week when we talked about risk management. And then he went on to ask an even better question, which is, let me just get to it here. What if the profit target gets blown by? Do you just follow the profit target no matter what or find a new exit? And I said, look, if your profit target gets triggered, you leave a piece for the dream, right? Let it go until, you know, there's a clear trend change. And then, you know, obviously you don't want to be underwater on that portion of the trade. That goes without saying. But, I mean, we talked, it's so easy to say. So easy to say here, hold a piece for the dream, hold a piece for the dream. A lot harder, pardon me, to do in real life when you see that blotter, the profit blotter on the side there, and you know you're up nicely and you want to lock in the profits. A lot easier to say than to do.
It's easier to dream than to hold the piece for it.
Right? Practice, practice, and more practice. Blackberry, Sharif, Adara. Our psychology and neuronal chemistry can turn probability into hope. Very good point. Ooh. That's one possible pitfall in trading psychology as I experienced it the hard way. Care to give an example, Blackberry? Because I think you're coming on to a very good point here. But I think one of the things is that if you have objective criteria that you've articulated, sure, you can break that objective criteria. No one's stopping you if you're not accounting to anybody, but at least you know that you're breaking. And so when you look at it on an ex post facto analysis and you make an assessment, what did I do wrong here? You have that. You have that in front of you to know, well, I didn't do this, or I did this poorly, or I could have improved on that. What happened? We're just testing a microphone. Oh, okay. Like, what is going on?
I really thought, like, I was like live trading update.
And like the Katina man started yelling about the market going crazy. I looked at say that again? The Katina man is now short Shopify.
Yeah, but it's not that new.
It's from 72.90. He's taking the Canadian dream short, baby. The Katina man is short Shopify at 72.90. If you are following along with the Katina man and his trades, be made aware of that. All right, guys. About 8 minutes left on the show. Put your questions in the chat for Adara and I, or I'm going to start talking about soccer and football real soon here. And
it's a threat. It's not a promise.
I love how, yeah. Well, you know, we'll start talking about it anyway. The Katina men's team all of a sudden has decided, you know, there's a few games left in the season. Let's make a playoff run. Where was this before? Right? Jordan Love all of a sudden looking like the new Patty Mahomes? No, that's an extension, of course. Probably better, says the Katina men.
We are the youngest.
They are.
Average age 25.7.
That's young.
They are the youngest. Green Bay Packers is the youngest team in the NFL with an average age of 25.7. Correct. 25.7 years old. That's good. Good building. They're building, obviously, for something. We'll see how they do. But, yeah, look, now they're obviously looks like Detroit's going to win the NFC North. So he's displeased with that. But hey,
what's Detroit's team name?
The Lions.
Lions, okay.
Yeah. I went to an 0-16 season for them. 0-16 season. It was, I believe, 2009 or 2010, and me and my buddies went there to troll them. And we.
That's so mean. Beating them when they're already down.
I was a young punk. Who cares? And I held up a sign that says, "Eat 'em up, Lions! Eat 'em up!" And then we kept doing that, and then people in Detroit wanted to beat us up.
Yeah, I'm sure that didn't go over really well for people whose team it was.
Yeah, it was. No, they weren't happy about that. Man, but like basically the tickets were super cheap at the time.
Oh, that makes sense. Yeah, because I'm sure like no one is buying when the team is sad. But yeah, no, that's a young team. It
was hilarious. Benton COYG, baby. Come on, you Gunners. Arsenal, numero uno in the Prem. 2-point difference now between Arsenal and Liverpool. And I'll suggest to you that Arsenal's defense way better than Liverpool's defense. Liverpool won because of their offense, not because of their defense. Woo. Get 4 by, but they let in 3 from Fulham? Really? At home? Really? Yeah. Come on, big FA Cup draw against Liverpool. Yes, sir. They will be playing at the Emirates, though. So let's take care of some Liverpool here. That's what.
Sorry, there's a question too. I just want to say quickly from Tobias Hernandez. Is always being early to play is just pure luck or a sign of good read on market?
Can you say that again, please?
Sorry, I said it really quickly.
Yeah.
Is always being early to plays just pure luck or a sign of good read on market pulses? I think that's a really good point. I think sometimes for myself, if I think I'm seeing something, but I'm not 100% sure, I like to wait for a couple candles. I usually use the 3 or the 5 minute chart. So I like to wait, like let's say like 6 to 9 minutes or like 10-ish minutes to kind of see, am I correct about the direction?
Yeah.
If I am seeing some more candles to confirm that, then I'll hop in and I'll just make sure I have a really strong kind of stop or out point that I want for myself, right? And that way I feel more confident getting into trades that I might be a little ahead of the curve on. So for example, last week, my Nvidia short that I did admit I entered very early, but I entered because I saw a lot of confirmation that we were gonna break that level. And then when we did break that level, you know what I mean? Like sometimes it pays to be a little bit early, but I think if you are gonna be early, I would say be very cognizant that you're early and be even more careful about setting your entrances and your stops. But I don't think being early is a bad thing. And I think, if you're noticing these market trends, I think that's really cool. I would just say, sometimes maybe wait for confirmation. But I really appreciate your question.
Yeah,
I think
very
it's
good
a great,
question.
Fabulous question.
Excellent question. DB says, how many time frames and what time frames do you look for to confirm patterns like cup and handle, inverse head and shoulders, etc.? You should look at multiple time frames, but stick to the time frames that you end up choosing so that when you do a data analysis later, you're looking at the same thing and it's not novel every time around. Personally, here's what I use. When I'm on the small cap gappers, I like the 1, 5, and daily. That's just me. But when I'm on the large cappers, I like the 5, the 15, and the daily. I'm less interested in what a large cap is doing on a 1 minute chart as I am as what a small cap gapper is doing on a 1 minute chart. That's just my personal take on it. You can give it a try, so to speak. But the whole point here is I have a narrower time frame, like the 1 and the 3. Adara likes the 3. I know Neil likes the 3 as well. And then you have a little bit of a wider time frame. You hear about Obi using the 15. That's obviously an intraday time frame, but it shows a lot of yesterday's price action. And as we saw on AMD not that long ago, that 119 level was an obvious level of support on Friday, and today it's acting as an obvious level of resistance. You'll be able to see that clearly on the 15. You may not see it on the 1 unless you really zoom out. So having a narrower, kind of medium, and then the daily time frame, to me, for intraday trading, seems to work the best. Give that a try, or some combination, or some similar combination thereof, and see how it works for you. But that is what I do there, if you are asking me. Sally Huang, Adara, Sharif, what has helped me was looking at the supply and demand levels. Bang, bang. And you can see that on the price chart as well. You can see, you hear about Obi sometimes talking about liquidity grabs. He gets that off the level 2. He can see that off the level 2. That same data is reflected, but in a different way on the chart. So whereas he excels in level 2, I'd like to look at the chart to see that. So you'll be able to see that, for example, on a hammer candle, where you have a very long lower wick, and then you have the upper body closing near the higher end of the candle. You know that buyers overwhelm sellers there, and there was a liquidity grab at that level. Yeah. So what's reflected on the level 2 can equally be reflected on the chart as well. So basically just two same ways to get the same data. Fry. How do you feel about having 2 different profit targets, one where you wouldn't mind to take and one that is your max profit to give yourself a window? Or is that too much? No, I think you're absolutely right. And especially if the particular trade that you're in has multiple levels of resistance. So there's not going to just be one level of resistance. You are likely to encounter multiple. You may or may not. But if you do, have that first level of resistance as your R1. Remember when we talked about pivot points on Friday?
That's actually a really good example. Yeah.
There was that R1, resistance level 1. There was also R2. There's a reason for that. Chart to see where the obvious resistance levels are, and those should be your profit targets. In the same way that where the obvious support level is, that should be your stop. And you can do the same thing and get out half at stop number 1, and then maybe get out the other half at stop number 2. As long as you follow a consistent system, don't change it up unless you change it up for an extended period of time. The reason I'm saying that is when you collect the data later to see how your trades did, you have to have a standardized system to collect data. Otherwise, your data is not going to mean anything. It means like I did A on Monday and I did B on Tuesday, and when I reflect on my data, it's skewed, completely skewed. So I'd say that to you. Any final thoughts, Adara, as we wind down the show?
Yeah, no, I think the whole idea of a consistent system is really important. It's really hard to evaluate what you're doing, if you're doing a different thing every time. At the same time, too, I think especially if you're learning like myself, and I am benefiting from the simulation trades, but I do think it's kind of great too if you're not having tons of success. Modify your strategy, see what works and see what you're comfortable with, because everyone's trading personality will be different.
All right, it's 2 o'clock.
Let's send it off.
You know what to do?
I mean, we had a great time today here with all of you. We hope you guys learned something. Cannot wait till we do more trading psychology tomorrow. Same bat time, same bat channel. For now, Brendan's at the big desk.
Hey guys, welcome in. Monday afternoon here as we head through a pretty choppy session overall. We are trying to get a little bit of a rally going here this afternoon, but overall, red board that